we've already had a bit of a melt-up in the first half of the year, so we don't necessarily see another melt-up happening.
Inflation could keep rising, it's already rising, but stay higher for longer.
It's really about the supply side of the economy that we don't have very much information at the moment.
The idea here is that the Fed is going to be behind the curve when they do start the tightening process.
I don't think those rates are going anywhere. I think the Fed has been very clear that they're not going to allow any part of the curve to really get away from them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up 14 on the S&P, up 1/3% on the Nasdaq. Tech stocks doing nicely over the last week or so. And here's a headline to start the program from the Morgan Stanley CEO, Mr. Gorman, saying that he sees the Fed raising interest rates in early 2022, Tom. That's not too far away.
Now, center tendency, I call it 9 months away, which in Fed speak, folks, is 3 meetings, 4 meetings, where it becomes really front and center. It really sets up. Let me get the fancy chart up here, John, that we've got on the Bloomberg terminal. FOMC go. You know it. You love it. How about September 22? How about November 3rd? The Gorman theory is front and center.
I always love this, Tom, because the chief executive comes out with one view, and then Ellen Zentner and Morgan Stanley's got to come out into the media on TV over the next couple of weeks to give us her view.
She's fly fishing, folks, over in continental Europe somewhere, and she's looking at her phone going, he said what?
Here we go. James Gorman of Morgan Stanley, Lisa, speaking at the Nikkei Financial Conference in Japan, said that the Fed would begin tapering towards the end of this year. That's not too controversial. A rate hike in early 22, that would be a surprise for many.
Yeah, actually, one thing, just to front run myself, we're looking at a 2-year auction today of treasuries. I was looking at the fact that you've basically seen a flatlining in the actual yield that you're earning on 2 years. Basically, nobody is pricing in the Fed moving away from their near zero rate policies for the foreseeable future.
Let's stop the show. Lisa, I want you to inform people like me who could care less about auctions. What information do you get from them?
You get a sense of who's in the market bidding. You get a sense of how much the dealers are positioned for to take down and how much investors really are interested in coming in, and whether they are indirect investors, whether they are foreign investors, whether they're direct investors. You get a sense of the demand dynamics. By the way, Tom, I'm never going to unhear FOMC. You know it. You love it. John, please help us get back on rails.
I do totally love it. Your 5-year auction comes tomorrow, Tom, if you're interested in that. And a 7-year auction coming a little bit later in the week, too. Here's the price action. It's Tuesday morning. Good morning to you.
Of the curve.
That's right, Tom. The belly of the curve yields up by not even a basis point. We're down by a basis point. A break of 160 at 159.10 on a US 10-year. A break of 160 to the downside. We'll touch on that a little bit more, a little bit later in your equity market. Through 4,200 on the S&P, up 15 or 16 points, Tom, up about 0.4%. And a euro, I've got to say, euro stronger, dollar weaker. Some dollar weakness in the mix today, 122.53, Tom, on euro dollar.
It is different, John, than yesterday. I want to make clear. Yesterday was a market struggle. Equities were up. Everything else was a snooze fest. And, John, today is a lot more informative.
A Monday snooze fest, Tuesday more informative.
It's true.
Oh, TK,
not every day can be lights out, you know?
Equities were having a really nice day yesterday. You call that a snooze fest?
Okay. Do you guys want to find out what's going to be today? That's going to be more informative and not a snooze fest. 10 a.m., we're going to get a slew of economic data, including U.S. new home sales for the month of April. Basically, sales numbers have gone down as prices have gone up. Just to give you a sense, the median home price in the United States has risen 19% year over year. I mean, just to give you a dramatic sense of the climb that we've seen here, and that is the most in records going back to 1999. Also, May consumer confidence. Check out here expectations for inflation. That is what I want to know. Then also at 10 a.m., Fed Vice Chair of Supervision Randy Quarles is presenting to the Senate Banking Committee, rather. I am very curious to see how much he raises concerns about financial stability, about pockets of froth. One thing I've been noticing is the Federal Reserve has been less willing to talk about froth in markets than other central banks globally, which point to the U.S. as the center of said froth. Kind of an interesting dynamic that is emerging. And then at 1 p.m., you know it, you love it, Tom. U.S. is selling $60 billion of 2-year notes, setting off a slew of auctions tomorrow, as John was mentioning. We've got the 5-year auction. And then on Thursday, about $60 billion of 7-year notes. Dun, dun, dun. This is the auction that always creates trouble. And yes, I like to get a sense, John, of who comes in to bid, who wants to buy, because because it gives me a sense of where the marginal demand may come from going forward for treasuries.
I'm with you. I'd like to do the same thing, and most people in fixed income do as well. The chart of the 2-year yield, Lisa, as you alluded to at the top of the programme, has not had a heartbeat for a long, long time.
Yes. I mean, that's the thing. And no one's expecting the Fed to raise rates anytime soon, except for evidently Morgan Stanley's chief executive officer.
I'm so pleased James Gorman spoke this morning because I had nothing to say 5 minutes ago. The Morgan Stanley CEO seeing the Fed raising rates in early 2022, speaking at the Nikkei Financial Conference over in Japan. Gilles Moek joins us now, AXA Group chief economist. Gilles, if you'll indulge me and start there, a rate hike in early 22. Any pushback there, Gilles?
Yeah, quite a pushback because it would be really detrimental to what the Fed is trying to do here in terms of credibility. I mean, you cannot really push the story of average inflation targeting, pushing the idea that you will tolerate inflation and so forth, and then have a rate hike as soon as 2022. For this to happen, you would need to see a complete change of view at the FOMC, a sense that inflation is completely out of control, possibly the risk that financial stability issues would really take precedence over what they're trying to achieve on the inflation side. So everything's possible in this world, obviously, but it would certainly be a big shock. It would take a lot, I think, for the FOMC to accept basically failure on the average inflation targeting strategy so early in the process.
Gilles Moek, you've always strapped academic economics over to market economics, and some of that comes back to the Greenspanian invention of a measured central bank. Do you presume that any central bank, and particularly Mr. Gorman's Fed, can be measured in 2022?
They're going to be under massive pressure potentially, because one state of the world I constantly think is what happens if inflation is actually in control, consumer price inflation is in control in 2022, which is our baseline actually. But at the same time, you have very, very strong prices, a strong increase in debt, in leveraging. Pressure will be immense on the FOMC to kind of shift focus, disregard what's going on the inflation side, and go into a hiking process. But again, that would go against the sense of stability, of predictability that the Fed wants to put in place.
Yeah.
So it's going to be challenging, but the cost to the Fed's credibility in changing tack so soon, I think, trumps a lot of other considerations.
Gilles, is it just me, or does it seem like the ECB and other central banks around the world, including, frankly, the PBOC, have raised concerns about froth in U.S. markets? And the Federal Reserve has been incredibly sanguine about said froth. Can you talk a little bit about what you make of this dynamic?
Actually, it gets me back to my old days in public service. I used to work for the French Central Bank, and I was there at the time of the big global imbalance story. At the time, 2004, 2005, everything was about the U.S. running their economy red hot, Greenspan, not wanting to run a tough enough monetary policy, and everyone else in the world at the ECB, was clearly the case, was saying, you're playing with fire here. You should actually try to stop this asset price bubble before it's too late. Actually, we got it wrong in the sense that what triggered the shock in 2008 was actually not asset prices. It was at least not financial asset prices. It was housing, but foreign central banks will always say that about the Fed. You are playing with fire. You disregard financial stability issues. And my guess is that, again, we need to pay attention to the fact that there is this big disconnect between a U.S. economy, which is doing really, really well, ahead of most other developed economies. And when you are in this situation, you will always have the same dialogue. The Fed is going to say the reason, for instance, why our current account deficit is rising is because you guys are not doing enough to prop up your own economy. It's not because we are inflating our economy. And the others will say, look, you are creating some danger here with what you're doing with reflating the economy, because this could actually trigger an increase in long-term interest yields for everyone, including Europe. So I guess the problem right now in Europe is the sense that, as usual, even if the Fed is super sanguine, is super benign on inflation, long-term interest yields have increased in the US, and there is some contagion to Europe. And it's coming at the wrong time for us. We're not as advanced as the US on our exit from the pandemic crisis. So, it's no wonder if we are a bit critical.
Starting to see that in the Italian bond market a little bit more over the last month too. Gilles, we've got to leave it there. Gilles Merck there, the AXA Group chief economist. Here's the headline from James Gorman, the Morgan Stanley CEO. He sees the Fed raising rates in early 2022. Now, there's two ways of looking at this, Tom. Either you can disagree with the Fed's forecast, that's one thing, or you can disagree with the framework and the new reaction function, and you can question that and whether the Fed capitulates. They're two different views, though, and it's not clear to me whether the Morgan Stanley CEO is saying, I disagree with the forecast, the reaction function doesn't change, but the forecast, the price pressure is going to be there through 22 in a way that isn't transitory, which pushes them to move. And that's the thinking. I think it is key. You can disagree with the Fed, but how you disagree with them, I think, is important. Are you disagreeing with their forecasts, or are you questioning their new reaction function?
Well, the reaction function is a key thing, and the key thing, John, is it's plural. It's not one single reaction function. There's a number of things going on here, the fiscal dynamic, the monetary dynamic. And I, again, as I've said for days and days, I would look at the real economy dynamic. I'm sure that's one part of what Mr. Gorman's looking at. And the tea leaves will tell, John, and one of those tea leaves this morning, John, let's frame right now on euro as we nudge towards a 123. Anything above a 123 is a big deal.
We saw north of 123 earlier this year. I think January 6th was the high. And if you look at a chart of euro dollar right now, Tom, it looks like a V. Year to date, euro dollar dropping. We saw the dollar dominance, the Q1 US exceptionalism story, and Q2. That story, Lisa, is starting to change. It's going the other way.
Well, and this is what I was going to say. Where is the pressure for the Fed to change their reaction function? You're not seeing a materially stronger, or frankly, the weaker dollar isn't material for the country. And meanwhile, you're seeing longer-term inflation expectations come down.
But it can come from the data. You can still disagree with the forecasts. And the Fed themselves have said, if inflation continues to overshoot in a way that we don't anticipate, then we'll make a move.
But it'll take longer than just the next couple of months. That's my sense.
Totally. And I think that's going to be a story for the end of the year.
Correct.
We'll find out whether it's transitory or not, and they'll have to draw some conclusions from that. Coming up at 7 a.m. Eastern Time, we'll be catching up with Anna Han of Wells Fargo. We'll do that in about 45 minutes. Your equity market with a lift up a third of 1% on the S&P. Yields lower. A break of 160 on a 10-year, 158.93. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The entire world has been battling the same virus for over a year, but the quality of life and control of the pathogen spread look vastly different depending on where you are. There's a shakeup at the top of Bloomberg's COVID resilience ranking, with last month's #1 Singapore falling in May, along with other Asian economies. In contrast, the US and parts of Europe have been steadily climbing up the ranking as the pandemic slowly recedes and vaccination numbers climb. The UK jumped 7 spots to 11th, and the US is number 13. New Zealand took the top spot. U.S. Secretary of State Antony Blinken landed in Israel this morning on a Middle East mission aimed at shoring up the recent ceasefire between Israel and Hamas. Blinken is meeting with Israeli Prime Minister Benjamin Netanyahu and other top Israeli officials in Jerusalem, and will then head to the West Bank city of Ramallah to speak with Palestinian Authority President Mahmoud Abbas. Deutsche Bank is moving about a quarter of its corporate bank's UK staff to offices in the European Union and Asia. Bloomberg has learned about 100 jobs will be moved in an attempt to reduce costs in pricey locations like London and put staff closer to the clients they serve. The bank says some London-based employees can reapply for their jobs in the new locations, but they will be required to take a pay cut. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We do have to strongly condemn the actions of the government of Belarus. You know, what they did on Sunday, intercepting a commercial civil aircraft, clearly put the passengers and crew of that aircraft at risk. and forcing them to divert is unacceptable behavior by any government.
The story of the last week from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. It's the Tuesday morning price action. Equities, the bounce continues on the S&P 500, up around about 0.25%, positive 11 points. On the Nasdaq 100, up 65. We advance 0.5%. Yields breaking down through 160 at 158.76. We're down a little more than a basis point now. And the euro breaking out, the dollar weaker. Cable in and around 142. That's the pound against the US dollar. Euro dollar, Tom, 122.57.
Yeah, everything on the screen, the euro gets my attention most. John, I'd also note the real yield backs up. It's not a big deal. It's midway in range, but a negative 0.88 is not where we were yesterday, is it?
Worth keeping an eye on, Tom. Another thing to keep an eye on, an interview going on with the German finance minister and our esteemed editor, Stephanie Flanders. That's taking place right now. The German finance minister, Olaf Scholz, saying we're really, really angry about the action by Belarus. And then a question on the commercial relationship between Germany and Russia. And the German finance minister going on to say the Nord Stream 2 project is a private project that is almost complete. And that's where there's some real tension now between Germany and the Allies, including the United States, Tom, and the relationship, the ongoing commercial relationship with Russia.
Well, it is, and it's the layers of sanctions and the level that any given society wants to go to. Martin Schenker joins us now, Bloomberg editor-at-large in charge of all sanctions study, including, Marty, our Ute, where you and I saw sanctions work in South Africa. Everybody said they wouldn't work, and boy, did they work with a vengeance. Different story, different time and place. I walked in this morning, and Guy Johnson taught me to look at FlightAware, and there was FedEx flight. Let me get it up here on the screen. I just lost it looking at the 2-year auction coming up this afternoon. It was FedEx flight 5030, China to Germany, flying over Belarus. Is FedEx doing their part?
Well, the question is, does FedEx have an alternative? I mean, if it's FedEx, it's obviously a cargo flight. There are no passengers involved. There's been no formal ban on flying over Belarus at this point, even though there are people calling for that kind of sanction. But it seems unlikely they're going to be able to enforce that.
It seems like a lot of our audience is saying, look, you can fix this. You just got to put some will in place. With your reading, do you see, in our reporting, I should say, does the will focus just on Belarus, or are we going to have to pull Moscow into it as well?
Well, I think that, they want to avoid pulling Moscow into it. And in fact, we do have some reporting around what's happening in Moscow that Putin specifically wants to distance himself from this action, even though the foreign ministry sort of backed it. So it's a little unclear just how coordinated this thing was.
Marty, how much does this complicate President Biden's summit with Putin?
Well, it makes it adds another layer of complication for sure, Lisa, because, the world has a way of imposing its agenda on world leaders, and this seemingly rogue action is going to force Joe Biden to confront Vladimir Putin on his involvement in this.
How much consensus is there, Marty, among Congress members about the approach that the U.S. should be taking with respect to these discussions with Vladimir Putin, especially given some of the dissonance between Biden's perspective and former President Trump?
Well, I think there is relatively bipartisan feeling in Congress between Democrats and Republicans that Vladimir Putin needs to be confronted on these issues, not just on what's happening in Belarus, but even going back to election interference and other things that Russia has refused to acknowledge.
Marty, let me wrap up the script. It's that time of year where Congress types go home.
Right.
What do they actually do when they go home? With your years and decades of experience, what do they actually do when they go home?
They fundraise. To be quite honest, they do hold some interactions with their constituents, but most of the time they're meeting with donors and making sure that their campaign finances are in order.
Are they told what to do? Does it ever change the dialogue in Washington that they go home and so-called listen to constituents? I don't buy it for a minute.
There are rare occasions where the public mood is so great that it might, in fact, cause them to change stance, but most of the time it makes no difference.
Right now, we're waiting for Republicans to come back with some sort of counterproposal to the $1.7 trillion reduced bill that President Biden has put out there. Do we have a sense of the contours of what that counterproposal might look like?
Well, they have, the Republicans who are negotiating on this bipartisan bill have said the $1.7 trillion has things in it that are simply not infrastructure, and there's just no way they're going to go there. So it's going to be an interesting dynamic to see if Joe Biden is willing to compromise in the hope of getting a bipartisan deal on infrastructure.
Marty, just quickly, do you think there's a clock ticking here on these talks?
Yeah, I think they are. I mean, he wanted to get this done before July 4th, and it's looking less likely that they're going to be able to do that.
Marty Schenker, our Bloomberg editor-at-large. And Tom, that clock continues to tick. We caught up with Emily Wilkins yesterday, and I think she nailed it to some degree, Tom. Looking through to the midterms next year, it's not about getting this done before the midterms. It's about getting it done and making sure it's already executed before the midterms next year so that people actually see it, feel it, experience what comes out the other side of this bill, and not just looking at a bill and an agreement in isolation.
In isolation, I'm going to go nothing's changed, John. The other side doesn't want the other side to get credit for any kind of legislation. I mean, it's just simple as
and
that.
And defining the scope of infrastructure, as Marty said a million times. Tom, that's still a question that we haven't agreed on the answer of.
Well, we haven't agreed on infrastructure, and we haven't repaired the bridges in, I'm going to say, 30 years. I mean, this is not a new thing. It's been going on for decades.
And, Lisa, many people expect it to go on for a few more years, maybe.
Exactly.
Yeah, although this is all coming at a time when we're still dealing with the disparities from the pandemic that were exacerbated by the pandemic. And the Biden administration wants to address them and wants to convince people that this is part of the economic dynamism of the United States, that bringing people up and being more equal is actually an economic case. And the question is, where is the data and how they're going to sell that to a highly skeptical Congress?
Well, we have a fundamental philosophical disagreement on one thing at the moment, don't we? What is infrastructure? That has been the story now for the last several months, and that seems to be a hurdle that they can't get over.
No, and this is part of the issue because the infrastructure spending plan doesn't have that much in terms of traditional infrastructure. That said, can they broaden infrastructure beyond roads and bridges to, for example, more energy efficient projects and things like that? I mean, aside from some of the social projects, how much are they willing to cave on both sides, John?
Coming up on this, Marvin Lowe, State Street Senior Global Macro Strategist, that and more, and on this market too. As we break out in the equity market the last couple of days, your S&P 500 up 12, we advance a third of 1%. The Nasdaq up 65, call it 66 points higher on the Nasdaq 100, up about a half of 1%. Yields coming in this morning by almost 2 basis points.
What does that mean,
or so.
John? Yields in. What's it mean?
Points. Tom, we talked about this the last couple of days. You just happened to ignore me over the last week.
Deflation?
We're waking
just the
up
past couple of days.
to the same story every single day. And when you get bored of the same story, you have to ask yourself how loaded the boat is to the one side. And I think Matt Hornback and Morgan Stanley did a nice job of pushing back against that. So many people are talking about the same thing. When everyone starts to zig, you have to think about whether you want to zag.
We had Matt
Yields are
on?
starting to come in. We had Matt on yesterday.
Oh, we did? Okay,
we
thank
did.
you.
Tom Keene, Lisa Abramowicz, Jonathan Ferro. Nothing changes.
Attention's transitory.
This is Bloomberg. .30 in New York for our audience worldwide. This is Bloomberg Surveillance. Your equity market shaping up as follows. That bounce continues. On the S&P 500 up 11 or 12 points. We advance a third of 1%. On the Nasdaq up about a half of 1% after a really big gain on the Nasdaq 100 yesterday. The gains continue. Switch up the board and get to the bond market. 2s, 10s and 30s. Your yield curve shaping up as follows. Your 10-year over the last 1 year. I keep doing this, don't I? Breaker 160 on a 10-year at 159.10. We'll be talking about the 2-year a little bit later. Lisa going through the supply, the bond auction coming later on today, 5-year tomorrow, 7-year coming up on Thursday. Your 2-year has not had a heartbeat for much of the last 12 months since the Fed dropped interest rates. When the likes of Morgan Stanley's James Gorman makes a call like interest rates are going to start rising in early 2022, you've got to start thinking about why. This is what the Fed essentially offers, a set of forecasts and then a reaction function. In plain English, this is where we think the data will be, and this is how we'll describe how we'll react to said data. So if you're going to disagree with the Fed, are you going to disagree with the forecast, the data, or are you going to disagree with how you think they'll react to that data? I think the bar for the latter is higher than the bar for the former. You can disagree with the data. Do you really want to disagree with the reaction function? That implies you know what they are thinking or what they will think in the future. That's a different ball game. That's the bond market right now. In the FX market, shaping up as follows for euro-dollar. We do have a chart of that. Euro-dollar. What I like about this chart is that euro-dollar, for all the talk of the dollar bearishness at the start of the year, euro-dollar came all the way down to 117, and euro-dollar bottomed when 10-year yields peaked. That was almost the peak of US exceptionalism versus the rest of the world. And then we started to change. Euro-dollar getting back out to 122.53 this morning. The high of the year was 123 on January 6th. Tom, we're not too far off, and I think you've said repeatedly that when we start to inch towards those kind of levels, expect some noise from the ECB.
Before we get to Marvin Lowe, John, this is so important. We got to frame it. We framed this 6 months, 8 months ago as a 130, 128 angst for Europe. That's changed.
Well, I've heard 125 over at Deutsche.
Yeah.
I've heard 125 over at Goldman. I have no idea what the ECB can actually do about it, Tom, even if they do start to talk it down. I actually think their biggest concern right now is not through the FX channel. It's what starts to happen in Italy on the periphery, and yields have been bubbling up just a little bit over the last month.
Now, the only reaction function I'm looking at is who the next coach will be for the Tots. It's steaming, it's percolating.
You think Pochettino comes back from PSG, Tom?
I do,
Maybe.
but I can't pronounce his name. What can I say? Right now, let's go to Marvin Lowe. He is with State Street, their senior global macro strategist, always writing really cogent notes linking Fed policy into the markets. Marvin, I want to go from Mr. Gorman and Morgan Stanley gaming out 2022 to the chairman with the weight of the world on his shoulders to what it means for the equity market. I want you to explain to our radio and TV audience what this Fed babble means for stocks.
You know what? It's as simple as how much liquidity and how ultimately dovish the Fed makes it for the market. With negative real yields, you've got a repressive financial system, and equities benefit from the fact that there aren't that many alternatives. If you're buying a treasury security at this point, you're buying into the view that you're going to lose money after inflation, ultimately. In terms of how you parse the Fed, in terms of whether or not they're correct that inflation will be transitory, is the key that all of us are asking right now.
Yeah, I think this is so important, John. And for a radio audience, we've really got to state that we go from Gorman to Powell, and then the jargon is DJIA, John. Right? I did that for you. That's the Dow Jones
Thank you.
Industrial Average.
Marvin, when you responded to that question, you weren't talking about a shift in the Fed's reaction function. You were talking about the data maybe coming in hotter than they anticipate. Do you think that's the lower bar here, to disagree with their forecast, to say that actually it'll look a little different in the future to the way they anticipate?
Yeah, I mean, I think the real challenge is that the Fed is giving us a message that it hasn't believed in the forecast in the past. That's why they've become outcomes based. But everything is based on their view that data is going to be transitory. So from one instance, believe us that, the numbers are going to get back to normal into something that is much more familiar to what we've seen before. But at the other side, we don't necessarily believe what we've seen in the past is accurate. The risk is that not only the data comes in hotter, remains hotter, I think is kind of the important part of it. And the Fed is so far behind the curve that it's hard for them to catch up. Not necessarily saying an 80s type of environment again, but we're talking massive balance sheets with the potential for slip-ups here. Absolutely.
Marvin, do you think in one way they're contradicting themselves when they say we're an outcome-based Federal Reserve, but also we will give you a long enough lead time to know when we're thinking about, talking about whatever when it comes to tapering?
Yeah, absolutely. And I think what we saw earlier this year in terms of yields, in terms of real yields, kind of coming off the bottom, if you will, being less negative, if you will, is an example that the market is not necessarily 100% comfortable with the Fed's ability to do everything that it says. Having said that, to push against the Fed, where it does have cover to remain where it is now, is something that kind of keeps us in the range, even though we've had data on really both sides in terms of surprise to the upside and downside.
Marvin, where's the bigger risk right now, that yields go up or that yields go materially lower?
I think it's materially lower, to be honest with you, because to get materially lower, you've got to really abandon the growth that we expect to have, not only from reopening, but from the fact that we've got as much savings as we have, and we're predicting above trend for at least the next year and a half or so.
If that's the case, and a lot of people would agree with you, then isn't the Fed doing exactly what people would hope the Fed would do? I mean, in other words, run the economy as hot as possible because the downside risk to the economy, the downside risk to yields is way worse and more difficult for them to combat than the alternative.
Yeah, absolutely. And I think that's why risk assets remained as supportive as they have been over the course of the last couple of months, despite, whether it's medical virus volatility and or inflation volatility kind of making its way into the market.
Marvin, so much of the exercise right now, and I take this at a macro level, is all this news flow coming out of an original natural disaster into something original, a boom economy. We haven't seen this in 47, 48. What should our listeners and viewers do given a boom economy? How do they allocate given the macro flow of news?
Well, and I think rates and the Fed is the backdrop around that. So long as we've got these negative yields in a booming economy, it's really supportive for risk assets. It's really supportive for taking that equity risk, and I think that that becomes part of the asset allocation discussion. And then we start to parse things. This has been a market where we're looking for those that might benefit more than others.
Yeah, John from Coventry says go Matthew right now. Let's go Matthew, Marvin. When you see the real yield come up from a substantial negative level towards zero, as it did in Switzerland, as we're seeing German 10-year, is that a linear flow, or is John's using this phrase reaction function? Is that a linear or quadratic movement?
I think that the market should be able to handle 0% real yields. You shouldn't need a repressive financial system for companies to do well. There is a level within kind of that real yield discussion when it becomes much more positive than zero that you wind up with alternatives. And the risk reward amongst different asset classes come into play. But a zero real yield, which is at this point from a 10-year perspective, still 80 basis points away, shouldn't be enough to derail how companies are able to still perform well in an environment where you've got positive growth.
Marvin, do you think Europe can handle zero real yields?
Yeah, that's certainly a much different type of equation. Their demographics are different. Certainly, the amount of fiscal stimulus that they have is different. It's going to be harder, and I think that's the conundrum that the ECB has as they try to sound as dovish as they can, but ultimately, is moving along the same normalization path without as much of a growth response that we're seeing here.
Ultimately, though, Marvin, isn't that the tension, the issue here? That the US Treasury market can't trade in a vacuum, that it's the global bond market, and then you get a move towards zero real yields on a 10-year Treasury. Can you imagine what it looks like over in Europe?
It's the conundrum of the ECB. It's still a lot of different economies with a lot of different speeds, and you've got one organization trying to keep it all together with one number, whereas, certainly for us with the dollar and a more cohesive economy, it's much easier.
Good luck, June 10th, the next ECB meeting.
Yes, absolutely. The focus is going to be on what they do with PEP. It's going to be, everyone certainly is looking at the size of the balance sheets, and that being the first stage of normalization. The envelope structure itself leads itself to a natural tapering process unless we hear differently. So it's an important meeting in the middle of summer. Absolutely.
Marvin, good to catch up. As always, Marvin Lowe there of State Street, the global macro strategist. Your 10-year in Germany this morning, negative about 15, 16 basis points, coming out a basis point or so on a German 10-year, Tom, just coming in about a basis point this morning.
Yeah, I mean, they're coming in. And, John, I go again to everybody's talking higher yields. I'm looking to 4 digits, 1.5910 on the nominal 10-year. I think this show, John, we sort of expected this range and these attempts to come under 160. Most of the street's looking for 165.
Look, not my opinion. Matt Hornback of Morgan Stanley, I think, described where he was at recently pretty well in the last 24 hours, including on this show, Lisa, that he's starting to lean the other way. He's just starting to think about his bull case for Treasuries and his bull case forecast for the Treasury yield.
And one of the reasons behind this is how much there already has been that movement. I mean, you're talking about whether Germany can handle a no yield, a zero on the 10-year after having been negative for so long. Just to give you some perspective in some of the losses, the 100-year Austrian bond that was sold nearly a year ago has basically posted more than a 30% loss on a price-adjusted basis since then. I mean, just to give you a sense of how significant the move has been, John.
Coming up, Dr. Emma Shadalja, Johns Hopkins Center for Health Security Senior Scholar. We'll continue that conversation on the healthcare and the pandemic issues of our time. And your equity market up about 10 on the S&P 500. We advance about 1/4%.
See how she killed me on
Yields
that?
in a basis point.
How did I kill you on that?
I bought it at par. I mean,
oh,
it went
yeah?
to 140.
Triple leveraged?
You brought the 2117 century bond.
In the Swiss
actually,
bank
TK,
account.
that had a great year last year.
It did.
Delivered
I
you
didn't
more
get
than
out at
40%.
140.
You had a fantastic 2020. It did exactly
Lisa
what it said it would do.
Lisa just ruined my morning.
Oh, yeah? Well,
You
it's
enjoy your
transitory.
drink. You enjoy your drink. I'm sure it's not transitory. From New York with Tom Keene,
bought
Lisa
that piece
Abramowicz,
for
Jonathan
Vetville.
Ferro. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. More than 1.6 billion COVID vaccine doses have been administered globally. That's according to data collected by Bloomberg News and Johns Hopkins University worldwide. The latest vaccination rate is an estimated 28.5 million doses per day. Dr. Anthony Fauci, the top infectious disease doctor in the U.S., has said roughly 70% to 85% of a country's population would need to be vaccinated in order for a return to normalcy. President Biden will meet privately at the White House today with the family of George Floyd 1 year after his murder. The meeting comes as negotiators working on policing legislation in Congress are still stuck on how to hold law enforcement officers accountable for excessive use of force. Biden had hoped legislation bearing Floyd's name would be passed by the anniversary of his death. EU leaders are vowing sanctions on Belarus and are imposing an effective flight blockade on the country. That's after the forced landing of a Ryanair jet and the arrest of a dissident journalist. The bloc is looking at Belarusian officials who should be added to a blacklist. National leaders are also looking at broader measures to target businesses and entire sectors of the Belarusian economy. And a powerful cyclone is set to slam into India on Wednesday, the second in less than 2 weeks. Officials are gearing up for relief operations at a time when the country is facing the world's worst outbreak of COVID-19. Forecasters say the cyclone is equivalent to a Category 3 hurricane and will bring heavy rains and winds of up to 115 miles per hour to some regions in eastern India. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Rishika Gupta. This is Bloomberg.
I don't think it's going to be really sustainable to be putting on and taking off lots of different travel restrictions, especially when the travel restrictions are so porous. I mean, often the travel restrictions don't apply to citizens of your own country, understandably, but then they certainly can get infected and bring the virus in. So I think that, vaccination, particularly with the evidence that the vaccination does work against variants, really has to be the bedrock of a control strategy.
The travel restrictions remain confusing. That was Joshua Sharfstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's your equity market this Tuesday morning. Good morning to you all. We're up about 1/3% on the S&P 500, through 4,200. On the Nasdaq, up about 58 points. We advance 0.4%. Into the bond market, yields in about a basis point, a break at 160 at 159.10. A euro that is a little bit stronger against the dollar, up 1/3% in the euro's favour. Euro dollar 122.54. And crude just a little bit softer, lighter, lower. Tom, down about 1/3%, 65.85 on WTI.
On the pandemic, we speak to experts who've been very good about that. Some are new people recently, and also people that have returned day after day, week after week, including Amish Adalja with Johns Hopkins Center for Health Security and their senior scholar. Amish, John Ferro has been very good about the poker game of the different European countries. Let's triangulate as one example, the United Kingdom, Germany, and Spain. Are we naive in the United States that we're not triangulating New York, Kansas, and Idaho?
Well, I think the country's on different types of timescales when it comes to vaccination. But overall, I think that the country is looking better as a whole than many of the EU countries will do, where you've kind of got a hodgepodge of policies, a hodgepodge of vaccination rollout. So, for example, the UK is in a much better place than much of most mainland Europe. And I think you're going to see that distinction be present until a significant proportion of those populations are vaccinated, where you'll see different policies. And I think they also have different ways of thinking about the virus. And I think that I think the UK and the US in general have really been countries that have focused a lot on flattening the curve, preserving hospital capacity, and then sort of realizing that this is not a virus that's going to go away, where there are some European countries, as well as places like Australia and New Zealand, that have kind of a fantastical notion of COVID zero, which is not going to occur.
Dr. Adalja, the one common theme is to keep vaccinating people. In your head, what is the number of vaccinations per day for the U.S. to create momentum? Is it 500,000? Is it 800,000? Or do we need to sustain above 1 million units a day?
So I don't look at it in terms of doses per day. I did early on because that was more a function of how well our vaccine rollout was reaching the people that wanted to be vaccinated. And what we did is we used a prioritization scheme. Not everybody was the same priority to get the vaccine, and we gave a lot of those vaccines early on to high-risk individuals, nursing home residents, high-risk community dwelling people, in order to flatten the curve, in order to preserve hospital capacity. And that group of the population is very heavily vaccinated. If you look at people above the age of 65, it's about 3/4 of them are fully vaccinated. So that removed the ability of the virus to cause serious disease, hospitalization, and death. So now what we're dealing with kind of is what I would say a mop-up, trying to get community transmission down. But we're out of a position where this is a public health emergency in terms of threatening hospitals again. So I think as long as we continue to vaccinate as much as possible, that's great. But I think we've already achieved the first goal of the vaccine, which was to tame this virus.
Doctor, as you just said, this is no longer a public health emergency. Any reason to believe it could become one in the future?
In the United States, I think it would be very difficult to see this virus be able to spiral out of control and threaten hospitals again, because the virus doesn't treat people equally, and we have vaccinated really aggressively in those groups of people that constituted the majority of people who were being hospitalized. So to me, I think we've removed that ability from the virus. We've made it much more like other respiratory viruses that we deal with year in and year out. The more we get vaccine into people, the better it's going to be. But I think we really all can breathe the sigh of relief because our high-risk populations are protected.
If the variant that was first identified in India became the dominant strain here in the United States, Doctor, would you be able to say the same thing with confidence?
I do think that when you look at the vaccines, especially the mRNA vaccines, they seem effective when it comes to this Indian variant. So I think the solution to the Indian variant, the way to make your country resilient to the Indian variant, is to get as much vaccine into people's arms as possible. So I don't think any of these variants can pose that problem to the U.S. because of our vaccination strategy. If you're a country that hasn't been heavily vaccinated, these variants can be disastrous. But if you've gotten vaccine into the arms of the most vulnerable, then those variants are going to have a very difficult time putting people into the hospital. They may be able to infect, they may be able to move through your community, but they're not going to crush a hospital.
Dr. Adalja, it seems like there is a disagreement emerging within the public health community about whether this is a public health emergency still, or whether we've emerged in a post-pandemic era. What are the scientific underpinnings of that disagreement? In other words, is there some threshold that people are looking at where the cases will go down dramatically and that people disagree on that?
It's hard because each person kind of looks at this pandemic differently. And I've always said that I look at it from a hospital capacity angle, but other people look at it at a case level. And I think that's the wrong way to look at it, because this virus isn't something that can be eliminated or eradicated. Our goal was to be able to tame it and defang it. And if you look at the number of cases, I think there were about 25,000 cases yesterday. We're getting to the point where we're on the average of getting closer to seasonal flu or a bad seasonal flu. So to me, I think that kind of dampens the public health emergency. We've got enough vaccine into vulnerable populations. We have vaccine that's plentiful. We're still trying to reach more people. We're not worried about personal protective equipment supplies, ventilators, ICU beds anymore. We've got a pediatric indication. So I think all of that has kind of changed the way we have to think about this virus. And now we have to ask ourselves, would we do this for a bad flu season? And if we wouldn't do it for there, I think that's kind of how we would gauge where we are now in the U.S. with COVID-19. Of course, it's a very different story just outside the country, even in northern, just north of ourselves in Canada. But it's still something that I think we have to really recalibrate and change people's risk perception about this virus, because we've done such a good job at getting vaccine into people who really needed it.
As you allude to, that comes down to messaging, Doctor, and I think we've got to make a bigger effort on that front. And on the messaging, what kind of messaging do you take away from the travel restrictions right now? Can you make sense of them, Doctor, from a public health policy perspective?
I've never been able to make sense of travel restrictions for any infectious disease because they don't work. They're red meat for politicians because there's kind of this face value validity to them to the general public, but they never work. They give people a false sense of security. They have all these kind of weird premises baked into them that your own citizens don't have that disease, or that the disease isn't already in your borders already. All of that, it really makes no sense. I think travel screening and the fact that we've got vaccines, the fact that we've got rapid tests, that should be what we're doing rather than travel restrictions. I don't think they work, and I think they end up backfiring, and then it creates kind of a cascade of travel restrictions from other countries that are doing it, and they're not sustainable and really aren't supported by the science of what's going on with a highly contagious respiratory virus that's spread all over the world and has a very large spectrum of symptoms, so you don't even know where things are.
Doctor, we've got to leave it there. Dr. Amish Adalja of Johns Hopkins Center for Health Security Senior Scholar. Tom, you know the science is proven. COVID knows if you're a citizen or not.
They do. They do.
Of course it does.
They do. And they understand if you're in economy or business class.
Yeah, and whether if you're standing up to go to the restroom or if you're sitting down in the restaurant.
Yes.
I'm pleased we sorted that one out, didn't we? Eventually. Unreal.
Oh, Lord.
Coming up, Anahan of Wells Fargo on its equity market, up 11 on the S&P. We advanced on the Nasdaq as well by 0.4%. This
Matt Hornbeck was on?
is Bloomberg.
We've already had a bit of a melt-up in the first half of the year, so we don't necessarily see another melt-up happening.
Inflation could keep rising. It's already rising, but stay higher for longer.
It's really about the supply side of the economy that we don't have very much information at the moment.
The idea here is that the Fed is going to be behind the curve when they do start the tightening process.
I don't think those rates are going anywhere. I think the Fed has been very clear that they're not going to allow any part of the curve to really get away from them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures with a lift up 11 on the S&P. We advance about 0.25% on the Nasdaq 100, up 1/3% after a tidy rally in yesterday's session. Tom, for now, big tech making a bit of a comeback about.
Yeah, we haven't talked about it yet. Let's do that right now. Big tech coming back after being the darling, 8 months ago, 9 months ago, 10 months ago. And some of the charts just show how unloved those big fangs are, John. I was really unaware of that. They've been out of favor.
Well, if Morgan Stanley's James Gorman has his call materialized, Tom, then maybe things change again. A higher rate in early 22 over the Federal Reserve. The call from Morgan Stanley's James Gorman at a conference in Japan this morning.
We've got a guest coming up that'll really dive into this. But, John, this growthiness, valueness of what the Fed does it's almost like gospel right now. I'm not so sure it's gospel.
You pushing back, Tom?
No, I just think the certitude of if we get deflation, Apple goes up. If we get inflation, Apple tanks. I have trouble with that certitude.
You tell me where the rates market goes, Lisa, and I'll tell you where the equity market goes and the complexion of it. What do you make of that?
Well, that is what the presiding sentiment has been. I mean, it's not a coincidence that you've seen a rally in the Nasdaq and disproportionate gains in tech shares as the yield has come down, as you've seen longer-term inflation expectations come down. Look, on the Gorman point, on the idea that the bank executives are saying, yeah, we expect higher rates in the future, how much is this talking their book to? I mean, that will be absolutely beneficial for them, and they would like to see an environment on all counts where that happens.
You think the bankers want higher rates, Lisa? Do you?
Do you think the sky occasionally is blue? Good morning.
Sometimes.
Sometimes, that's fair.
This is a Thursday conversation. Already.
A Thursday conversation on a Tuesday. Equities up 10 on the S&P. Here's your price action this Tuesday. Just to whip through things quickly. In the bond market, yields are lower by a little more than a basis point to 158.93. The euro is stronger. Euro dollar 122.49. That currency pair bottoming out when the 10-year yield in America topped out at the end of March. We're back to 122.50, let's call it, up about a third of 1%, Lisa.
Yeah, just on the euro point, one thing that I look at every day when I take a look at the euro-US cross is the euro-Chinese yuan cross, because that seems to be also really important with respect to the ECB and how concerned they are based on the trading relationship there. As far as the data that I'm looking at today, 10 a.m. we get U.S. April new home sales. Expect them to decline as prices increase. I can't get the statistic out of my head. A 19% year-over-year increase in the median cost of a home in the United States. That is the biggest increase on record, even exceeding the housing boom leading up to the 2008 crisis. Also, we get May consumer confidence. Look for inflation expectations. 10 a.m. also, we hear from Fed Vice Chair Randy Quarles to be speaking before the Senate Banking Committee. Again, I want to hear about froth. How concerned is the Fed to this? How much does that affect, John, to your point, their reaction function? How quickly they will move to try to offset some of the ebullience that other central banks seem to identify in the United States? And then at 1 p.m., Tom's all over it. The auctions begin. Yeah. The 2-year notes being sold, more than $60 billion of them. Not a lot of action on the 2-year front. Nonetheless, interesting to see whether anyone agrees with James Gorman, that there could potentially be a rate hike as early next year.
You think of Mark Gurman there, the Apple reporter.
That links in Apple
Bloomberg.
with deflation.
Really interesting story.
You called me out on that one.
Really interesting story from the team.
Yeah.
On Square.
Yeah.
Yesterday. What did you guys make of that,
well,
Lisa?
This,
JP Morgan, bit of competition coming from Square, maybe.
Honestly, when you hear the bank executives talk about their future, they talk increasingly about competition, and it's not competition from one another, it's from big tech. And increasingly, that is what they are looking at, especially as we start to talk about the digitization of currencies.
John, I would look at it as a flow of funds. I'm less worried about the technology and all that, and I would look at it much more like within charge cards, credit card, think Chase, commercial banking, Marianne Lake, and the turmoil there. It's about the flow in and the flow outs of money with this new technology.
A report from the team yesterday that Square could be offering additional banking services to some of its customers. One to watch. Another one to watch, Tom, just quickly. Amazon, close to that deal with MGM Holdings, reportedly. We could hear about that as soon as this morning, as soon as today.
I read on this carefully, and what's interesting, John, is it does not include the old catalog. The MGM we know, Roaring Lion,
really?
Black and White movies. Warner Brothers owns that from another transaction ages ago. For example, I believe, don't quote me on this, Gone with the Wind is not owned by MGM. Even though the lion is there at the beginning, because I'm watching Gone with the Wind like every 3 weeks.
One of our 10 listeners this morning might quote you on that, Tom. So do you want to go away and find out if that's actually true?
The lion is there.
Or not?
Look, the lion comes on in the movies, and Vet Bill and Kennel Fee go absolutely mental.
Is that what
That's
happens?
what I know.
Anna Han joins us now, Wells
you,
Fargo
John.
Securities equity strategist. Like most guests at around 7:05, wondering what on earth is going on in this program. Anna, great to catch up. Let's talk about this growth bounce. What are you looking at that tells you this one doesn't last?
I think that question cut out a little bit at the end there, but you're asking me, if this growth bounce doesn't last. If that was the question, I would say, I think what you got right now is a pause in the rise in yields. And that pause or that slowdown in the pace is kind of giving that breather to this style. But, over the next several quarters, several months even, you look down the road, this reflation trade is going to continue. And even if we get some decent CPI prints for the next several months and the rest of this year, I don't think that's going to be enough to necessarily, force the Fed's hand into tightening any time before 2024.
Anna, the only reason we have you on is you go right to XY axis and Cartesian geometry here, and you're comparing and contrasting the two outcomes that we have. I would submit that it's not about a parabola, x squared, y squared, whatever, an exponential function, and it's not about a hump and being transitory. It's about the in-betweenness there. How do you frame the geometry between those two outcomes? That went over. Am I still or is she still? I think that was. We've got some audio. See, John, I just tried to go Cartesian there for Anna Han, the physicist from Yale, because I love her research notes on this.
Something just came back to me. And for what it's worth, we have some technical difficulties with Anna Han of Wells Fargo.
We do.
She does have a maths degree from Yale, so she understood everything you said, I think.
If she had
in
heard
the last couple of minutes. Tom, there's a great clip of you that the team in radio showed me years and years ago.
Oh, no.
And it's you asking a very complex, long-winded question of a Federal Reserve official.
And they went silent.
It went silent.
Yeah.
And said Fed official turns around to TK and just goes, I have no idea what you're talking about.
But they did. The problem is they actually did. But the thing is, Anna Han is writing about this. Guys, Anna Han writes one of the smartest notes on Wall Street. And, John, it's about the dynamics. And what I'm suggesting, and you guys can remember this, X, Y, single piece of paper. We all flunked geometry. There's that complexity.
Speak for yourself.
Or, John, how about the 3D space? I mean, if you bring other dimensions into this, like GDP, like pandemic recovery, like the dynamic of geography, then you get into huge complexities, and that pushes me away from the certitude of reflation, worry about the 1960s, or transitory, which is the theme of the moment.
The bigger challenge, I think, maybe at the end of the year, Tom. Yeah, fantastic.
Thank you. Okay.
The bigger challenge, I think, at the end of the year is probably not so much the inflation debate, it's the deceleration conversation for growth. And the reason I say that is because we talk about the former far more than the latter, Lisa, which makes me wonder whether the latter is somewhat more underappreciated.
Especially because stocks have been an inflation hedge, right? Increasingly, people have looked at stocks as an alternative to bonds even because they potentially could benefit from an accelerating cycle. What happens if Matt Hornback is right? What happens if bond yields fall, if the Fed does hold on, and you start to get this fear that the economy is going back to the paradigm that we were in before, low growth, low inflation?
To be fair to Matt, though, I think we're only 10 basis points away from the bull case right now at 158.93 on 10s. The real call, the real big bullish call, I think, is Mr. Steve Major over at HSBC, who I believe, Tom, is still looking for a move back towards 1% by year end.
Yeah, I'm glad you bring this up. There is still a case out there, folks, within all the gloom that's out there and the pendulum of higher yields, of wise people, they may be right, they may be wrong, are saying, wait a minute, the certitude is going to kill you. You mentioned Mr. Major writing in Asia for HSBC, and I would also mention David Rosenberg. They're just saying, calm down, and this is a varied set of outcomes. It's not just one reaction function, John, and we don't know what that path is going to be.
What it will come down to is inflation expectations, and if you'll afford me the time, this came from Governor Brainerd yesterday. A very important part of inflation dynamics is longer-term inflation expectations, and those have been extremely well anchored, implying that if we saw some development pushing inflation up, I wouldn't expect that to get embedded in the ongoing inflation rate.
I believe we've got Anna Han back with us for a short visit here now with the technical difficulties. And I want to go to the geometry here. What's between the certitude of transitory inflation and the idea of a fear of inflation back to the 1960s?
Well, 1960s wouldn't be my strong suit, but, I'll give it a stab. When you think about how the inflation picture looks right now, this transitory is this key word we've all been hanging on to. But how do we define it? How do we framework it? When you think about past recoveries, how much inflation do we have to see to actually see the Fed, take accommodation off the table? For us, even if we see change in CPI throughout this year, a notch above 3.5 to low 4s, and even in 2022, if we were to see, we expect probably a mid 2 to low 3% range next year. That still doesn't put a Fed rate hike sooner than 2024. If anything, we have $120 billion of Fed purchases going through a day. Having a little bit of that trimmed back is going to be the first step. But right now, we haven't even really considered those tapering. You hear whispers of it, but that's not really where we're at. So to see that persistent level of inflation is going to have to be higher than this sort of 3%. Through more than several quarters for us to really feel that we're at risk of accommodation meaningfully coming off the table.
And I appreciate the additional comment, and my apologies about the technical connection. Anna Han there, Wells Fargo Securities equity strategist. Send our best to Mr. Harvey over at Wells Fargo, won't you? You brought a market this Tuesday morning up 13 on the S&P. We advance about a third of 1%. Coming up in the next hour, David Costin at Goldman Sachs, the chief U.S. equity strategist. Looking forward to that with Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. This is Bloomberg Surveillance Live on TV and radio.
With the First Word News, I'm Rishika Gupta. Secretary of State Antony Blinken kicked off a Middle East diplomatic mission today with a pledge to help reconstruction efforts in Gaza. Speaking in Jerusalem alongside Israeli Prime Minister Benjamin Netanyahu, Blinken said he will specify an aid package to Palestinians. He vowed the U.S. will ensure the militant Islamic terror group Hamas won't benefit from the rebuilding efforts. Blinken also reiterated the U.S. commitment to Israel's right to defend itself. The entire world has been battling the same virus for over a year, but the quality of life and control of the pathogen spread looks vastly different depending on where you are. There's a shakeup at the top of Bloomberg's COVID resilience ranking, with last month's #1, Singapore, falling in May along with other Asian economies. In contrast, the US and parts of Europe have been steadily climbing up the ranking as the pandemic slowly recedes and vaccination numbers climb. The UK jumped 7 spots to 11th and the US is number 13. New Zealand took the top spot. Turkey's president is shaking things up at the country's central bank once again. Recep Erdogan has appointed economist Semih Tuman as a new deputy governor, whilst Erdogan's previous sudden decisions to swap out senior positions at the central bank jolted markets. This time the lira held steady against the dollar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
There's a lot of hard work ahead to restore hope, respect, and some trust across communities. But we've seen the alternative, and I think that should cause all of us to redouble our efforts to preserve the peace and improve the lives of Israelis and Palestinians alike.
That was Antony Blinken there, the Secretary of State for the United States from New York City. This is Bloomberg alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. Good morning to you all. Tuesday morning, equities up 13, advancing 1/3%. Some outperformance from big tech recently. Your Nasdaq up 65. The Nasdaq 100 advancing 0.5%. Outside of that, into the bond market, yields a break of 160 to the downside. South of 160 at 158.93, down a little more than a basis point. And in foreign exchange, euro showing some strength. Dollar just displaying a little bit of weakness. Euro dollar 122.53. Tom, up about 1/3% on that currency pair.
Yeah, euro something. Again, folks, if we see it up to a 123 and breaking higher, that's a big deal. We'll see if we get there on a more interesting Tuesday than what we saw yesterday. Right now, and as we've looked at Belarus and some of the other political issues, we need to center back to Gaza, Israel, and Palestine. Jack Fitzpatrick joins us, our Bloomberg government reporter. Jack, what I notice here, and we've seen it before, certainly back to 1967, if not back through before, is how quickly it falls off the American radar. The front of the Washington Post, the front of the New York Times, really no stories today on Israel, on Gaza, on Palestine. What will keep this fermenting in Washington, or will it drift away?
Well, keep in mind the Biden administration has not necessarily sought to put itself front and center in everything that is happening in Israel and Palestine. Clearly, the Blinken trip will do that. It's going to be in the news cycle as he meets with Israeli and Palestinian leaders, among others. But keep in mind, he's also, I think, notably going to meet with El-Sisi of Egypt and the Jordanian foreign minister, because other countries in the region kind of have to take the lead, probably more than the U.S., on going back and forth between the two sides in this to make sure the ceasefire sticks. The goal for the Biden administration appears to have not let the Middle East become the absolute top priority, but still being involved to some degree.
And Jack, I can do this because I know you're so well read in. Let's move up the Levant to Turkey. Establish the Biden relationship with Turkey right now versus what we saw with President Trump.
That's another one that they haven't exactly put front and center, but the Biden administration has talked about pushing back on more authoritarian regimes. I'm not exactly sure necessarily how to tie Turkey directly into this. That's not part of the Blinken meetings this week. But you saw, during a Turkish visit during the early Trump administration, a clash in Washington with protesters that was largely overlooked by the U.S. That's a difficult thing to negotiate for the Biden administration, at least to say the least for now.
Jack, you talked about how the U.S. might not necessarily want to inject itself front and center in a lot of these disputes. It raises a question of whether the U.S. can do that while reprising the former role of being sort of the gatekeeper for global affairs, for being the leader when it comes to wrangling up some of the allies. Is this something that is a concern to people? In other words, how to take a more national-focused view, similar to what President Trump had, while also reprising this role?
Well, they can do both. And in fact, Trump supporters would argue that the U.S. standing by Israel with absolutely no exceptions would be their preferred means of injecting the U.S. Into foreign affairs. So, the question and the thing that makes this difficult for the Biden administration is if there is a flare-up, then how does it play in domestic politics in the U.S.? Because there is a significant amount of pressure from the Democratic Party to find some way to push back on Israel after all the violence that occurred there. How would they do that in a subtle way without going overboard and pushing too hard against an ally? But I would not necessarily draw a distinction between what the Biden administration is doing to try to engage with the world and what the Trump administration did in terms of a wholehearted allyship with Israel, because that is still sort of the center of where the U.S. stands in this. They obviously don't have a relationship with Hamas, which is why Egypt plays a role here. So this isn't necessarily an either or. It's a how do the Biden administration officials handle the political delicacy of the issue and be involved without pushing too hard if they need to have hard conversations with an ally.
Jack, just to wrap up here, I want to just focus domestically on the counterproposal that Republicans are putting together to Joe Biden's reduced $1.7 trillion infrastructure spending plan. When are we expecting that counterproposal, and why is it important to watch that?
Well, we got the White House's $1.7 trillion counterproposal on Friday. We got a lot of negative feedback immediately from Republicans. But as of late yesterday, Republicans seemed to think this was still going on. And the White House was saying they expect another counterproposal at some point from Republicans. The negative feedback was enough so that it's unclear how quickly this is going to move forward. But there does seem to be some agreement, at least from Roger Wicker of Mississippi, who says if they could agree to something around $1 trillion, that could be reasonable for both sides. So this is moving, despite the negative feedback after the White House proposal. It's just moving kind of slowly right now.
Jack, just quickly, are these negotiations sincere? And what I mean by that, do you sense that they actually want to make a deal, or are we just going through this process to engineer, find some fuel to have the blame game in about a year from now?
I think the Biden administration has to at least try, which may or may not be sincere, because they're more or less being forced into this by Joe Manchin and maybe other moderate Democrats. It may be a moot point right now whether it's sincere, because if they have to keep talking and they have to continue to seem like they're working in a bipartisan way, they could more or less get dragged into a bipartisan agreement. But I cannot guarantee that this goes on forever if there's still so much middle ground between Democrats talking about a $1.7 trillion plan and Republicans talking about something closer to $800 billion. There's a lot of room in the middle. But if talks continue, then good things could happen. So it's sincere enough for it to continue.
And talks continue. Jack Fitzpatrick, Bloomberg government reporter down in D.C. What do you make of that, TK? What's this about? Do you think it's sincere?
I think the issue I would take, John, and it's not, you may be right that it's about a year out where this becomes a completely political discussion. I would suggest that's going to happen sooner rather than a year out.
Tom Keene, Lisa Abramowicz, Jonathan Ferro coming up. Shahab Jalanous of Credit Suisse, the chief FX and rate strategist, with your dollar breaking down a little bit, your euro dollar breaking out. Euro dollar 122.51, up about 1/3%. The equity market up 14 on the S&P 500. We're looking good on equities for the week so far, Monday into Tuesday, up 1/3 of 1%. Heard on radio, seen on TV. This is Bloomberg Surveillance. Two hours away from the opening bell in New York City this morning. Good morning. Approaching 3-week highs on the S&P 500. The Nasdaq, we advance 1/3 of 1% on the S&P, about 0.5 of 1% on the Nasdaq 100. Big tech with a bounce as yields start to settle down. Switch up the board and get to the Treasury market. A break of 160 on 10s this morning. Yields lower by about a basis point at 158.93. It is a snooze on a 2-year. That's exactly what the Fed wants to see. Your 2-year yield, about 15 basis points. A chart of the 2-year yield, no heartbeat for the last 12 months. We talked about that a little bit earlier this morning. Lisa guiding you through the supply this week. 2s later this afternoon, 5s tomorrow, 7s on Thursday. The test for me is going to show up in a 2-year yield. If you believe the Federal Reserve is wrong about their forecast, if you believe they're going to have to move sooner than anticipated because of that, that's got to show up in a higher 2-year yield. And right now, pinned to the floor. Mohammed Al-Arian raising a point out on Twitter this morning. Is it really about believing the data's going one way or another, or just the fact the Federal Reserve's still in this market, but at a massive rate every single month? It's hard to get a clean read on a Treasury market when you have a price-insensitive buyer buying up a lot of that debt. Switch up the board and finish on this. Talking of price-insensitive buyers and a bond market where you struggle to get a clean read. Let's get to the bond market. Negative 16 basis points on 10s. We were gradually making a shift towards zero, seemingly at one point over the last week. We stalled out at about negative 10 basis points. This morning we come in another 2 basis points or so. But TK, the challenge is starting to build, I think, much more so for the ECB on June 10th. The euro's starting to advance. Italian 10-year yields are starting to break out, and we need some guidance. And they don't have the luxury of repeating what Fed officials did in Q1, which is it's consistent with a brighter outlook. They're going to have to carry on talking about the risk to that outlook.
Now, the brighter outlook's there. The difference is it's May and not January. We'll get to that in a moment with a wonderful guest, perfect for a year on the edge of 123. Right now, and so many of you are waiting, hanging, watching every tick of when Mr. Bezos and Amazon will buy Metro Goldwyn Mayer. David Wilson has seen every MGM movie. He's Bloomberg stocks editor. You've seen Die Another Day, what, 10 times?
Oh, I don't know. I lost track.
Rocky, it was 10 times. What do we got? When do we get Amazon MGM? Sometime today?
Well, it's entirely possible we get that. And in the meantime, we sort of look around for stories that are, affecting the market. AutoZone was out with fiscal third quarter results, and it really sort of continues a trend that we've seen as quarterly figures have been released. Eye-popping numbers relative to estimates, not much reaction in the stock. Earnings well above analyst average projection in Bloomberg survey. Those same store sales for sales at stores open more than a year, up 29%. That was almost double the average estimate, and it gets you 0.1% gain in the stock.
And you told me to buy that at 50, and it's now at 1,400. That really worked out. I didn't buy it.
Well, that's how it goes, Tom.
Come on, it's pretty much a linear moonshot, isn't it?
It sure looks that way over time. A real success story for Eddie Lampert before the issues he had with Sears Holdings. But I digress. Let's talk about Luminar Technologies. This is a company that makes laser sensors that are used in self-driving cars. People familiar with the matter say the company has a contract with Tesla for testing and development of those autonomous vehicles. Now, what's interesting, CEO Elon Musk over at Tesla, he said, we don't need the technology that Luminar provides to be able to build our self-driving cars. Nonetheless, they're at least testing it out. So Luminar shares higher in early trading. And we've got to talk about Lordstown Motors. The shares are really taking a beating after results were out late yesterday. The electric truck developer raised its projection of this year's operating costs, cut its production forecast, said it's going to have to raise more money. They expect to end the year with no more than $75 million in cash and equivalents. You go back to March, they were looking for $200 million. So definitely taking a turn for the worse at Lordstown.
That's it?
That's it.
That's it. Lordstown Motors, thank you so much. Do you have a SPAC for us?
Not today. It really seems like the SPAC market's kind of cooled at this point.
Do you have a why for that? I mean, is it just they haven't worked out? I mean, in 30 seconds here.
Lordstown, by the way, is an example of a company that went public through a SPAC.
I knew that.
And so that's one reason. Another reason, you've just seen this flood of new blank check companies. So it's a matter of what are you going to buy?
David Wilson, thank you so much. Greatly appreciate it this morning. Right now in Euro, this is perfectly timed. Shahab Jalanus is at Credit Suisse. He makes a cottage industry of cross rates. Shahab, let's go to the major rate now, Euro dollar as well. Where is the tip point where European authorities, not just the ECB, worry about too strong a euro? Is it 125 or could it be higher?
It could still be higher. If you go back in time and look at the period between 2009 and 2015, a period that actually included a major European crisis, if you remember, around Greece and other issues, euro-dollar averaged over 130 in that period of time. It basically took Draghi and QE to change that psychology, and since middle of 2015, we've averaged around 114. So this level we're at now, around 122.50, is high by recent standards, but certainly well below the averages that we saw before 2015. So there is still room to the upside when you look at it from that longer-term perspective.
Shahab, the guide that we've had from the ECB, the Executive Board and the Governing Council has been to preserve loose financial conditions. The Italian 10-year yield is back inside of 1% this morning at 97 basis points. It was north of 1.1% in the last week. Do you think this move off the lows of February, when we were south of 50 basis points, Shahab, do you think this move is making them uncomfortable?
I think in isolation, no, simply because this move can also be attributed to improved reflation prospects across the euro area. And even those southern European countries, which were severely damaged, for example, by the loss of tourism income, their framework is looking much better. In fact, Credit Suisse economists have put out a piece looking specifically at the likelihood of tourism recovering across Europe. So that is something to bear in mind here, that can be looked at in a positive light. The other thing is, if you look at market-based inflation expectations, for example, five-year inflation expectations, they're still going up for the euro area as well. So that, to some extent, reflects global factors like rising oil prices. But again, from an ECB perspective, as long as that is still trending up, and we're back to levels around that we last saw around 2018 for that indicator, there's probably some degree of comfort that still holds for the ECB at these levels.
So, Shahab, without the framework that the Federal Reserve can lean on, their new reaction function, the ECB does not have that. Does that make it difficult to push back against a stronger euro?
It certainly limits their potential to do so. Having said that, there is going to be a strategic review of the ECB's targets and policies, which is due at some point in the autumn. And there is some thoughts out there that this strategic review could result in a more dynamic approach, for example, to meeting price stability targets than what we've seen before. Now, would that be as flexible as what the Fed has created for itself? That's an open question. But any move in that direction would still be something that would obviously be very important for the markets and would allow for rates to be kept lower for longer, even in the case of Europe. Again, the Fed has maybe pushed the system to its limits at this point, and maybe the ECB wouldn't be able to do quite as much as the Fed. But again, it's just something to put on the calendar for sure.
Shahab, something that's gone under the radar, although is increasingly coming to the fore, is this idea of digital currencies, in particular issued by central banks. And I go to this because we've heard about that from PBOC, and now we're hearing increasingly about that from the Federal Reserve. And bear with me for bringing this up, but I'm wondering how much you care about this, how much you care that the Fed is going to release this document later this summer about the digital dollar and its potential disruption to the financial system.
I think it's important, obviously, because any technological change that could affect the way business is done needs to be taken seriously. And certainly the cryptocurrency space is a hot space, not just for speculators, but there are people who feel that there really will be longer-term implications for the whole financial sector coming out of that space. So this is a reaction to competitive pressure, you could argue, from the private sector of the global currency space. And to that extent, the fact that there's a response coming from central banks is positive. Now, they could even find ways of adapting their policies around digital currency. Maybe there could be better ways of meeting some of their targets down the line if they embrace the technological change. So I personally think it's a good thing that they are taking this head on.
I mean, the reason why I bring this up is because it seems like volatility in currencies has been coming down, including the major ones. And I'm wondering what would have to happen to ignite those types of price swings, and what kind of exogenous shocks could you expect?
I think the most obvious way to create volatility in currency markets right now would be data surprises that extend even beyond the ones we've already had, to a point that effectively the messaging coming out of, for example, the Federal Reserve becomes completely untenable. And that's not impossible to see. If we were to see consistently high inflation numbers, for example, as we go into the summer, where the idea that basically this is all a transitory phase and that down the line we move back to a low inflation environment naturally. If that idea becomes materially challenged, we should see volatility not just in foreign currency, I would say in all asset classes that could be quite spectacular at that point in time. So I really wouldn't look at what's going on right now and project forward and just assume that it will be like this forever. I think the possibility is actually there for fairly high volatility in FX markets as we go towards the end of the year.
Recency bias, Shahab. You know how it works. You take the price action of the last week, you extrapolate it out 12 months. Shahab Jalanous, Credit Suisse, Chief FX and Race Strategist. Feels that way as a journalist, I've got to say. Sometimes, Lisa, you're always taking a price action at the moment and saying, is this going to continue?
Well, I mean, look, in fairness, when you have a very calm market, you're looking for what's going to happen. I mean, come on. Sure. You could talk about Snoozeville Mondays and possibly something happening Tuesdays, or you could try to extrapolate out and see what the reality is.
Sometimes you can just say what it is. It's got a little boring in foreign exchange. You can just say that sometimes.
Yeah, so what's going to make it change?
We can talk about that. What will make it change instead of what will keep it the same?
Well, yeah, but what he was saying is interesting, that basically, you know, some sort of shocking figure in inflation could make that change. Interestingly, though, Jim Reed of Deutsche Bank just put out this chart showing that inflation data surprises are running at the strongest on record. That you're actually seeing when it comes to those particular data points, incredible upside surprises already.
I appreciated this chat just to make up for Tom's little private conversation about, was it Lordstown?
Lordstown, it was a SPAC. We looked for SPACs for David Wilson.
Hasn't the Ford...
We're SPAC deficient.
The Ford EV plans just killed that. Isn't that over now?
Yeah, I don't have a strong view on that. My major view is I think there have been some big figure FX trades that have worked. Just look at Euro Yen.
That was a nice segui, as you might say. Coming up in the next hour.
I might.
Julia Coronado.
Matt Hornbeck said segui.
Oh, dear
Macro
Lord.
Policy Perspectives President and founder will be joining us. Equities through 4,200 at 14 points on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. More than 1.6 billion COVID vaccine doses have been administered globally. That's according to data collected by Bloomberg News and Johns Hopkins University. Dr. Anthony Fauci, the top infectious disease doctor in the U.S., has said that roughly 70 to 85% of a country's population would need to be vaccinated in order for a return to normalcy. German Finance Minister Olaf Scholz is backing a plan to require companies to report climate risks as he seeks to boost his environmental credentials in his bid to succeed Angela Merkel as Chancellor. Speaking today in a Bloomberg webinar on the German election, Scholz also weighed in on the week's hijack of Ryanair flight by Belarus.
Since piracy, you could understand that I'm really, really angry about what happened, and we cannot accept activities like this in Europe. This is against any agreement we had and have. And it is necessary that we are strict and that we continue to be strict.
In addition to corporate reporting, Scholz is pushing a proposal for a so-called climate club to seek an agreement with the US on the EU's plans for a CO2 border adjustment tax. And President Biden will meet privately at the White House today with the family of George Floyd 1 year after his murder. The meeting comes as negotiators in Congress are still working on legislation on how to hold law enforcement officers accountable for excessive use of force. Biden had hoped legislation bearing Floyd's name would be passed by the anniversary of his death. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
That liquidity is likely going to be waning. The Fed will be likely tapering at some point within the 12-month window. The ECB, even though they promised to ramp up their purchases under the PEP program, that's been pretty underwhelming, to be honest. So I think a year from now, that's going to be coming down. And even though it feels like, and we can observe a lot of liquidity in the markets today, I think that pressure will actually be coming off within the investable horizon.
Good to catch up with Gene Tenuzzo there, the Columbia Threadneedle Global Head of Fixed Income from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. Tuesday morning price action up 15 on the S&P. We advance 1/3% on the Nasdaq 100, advancing 0.6%, positive 80 points there. In foreign exchange, south of 160, a break of 160 to the downside at 159.27, down about a basis point. And that's supporting the story that you've seen play out in Nasdaq futures, though, as Tom and I and Lisa discussed a couple of hours ago. Is it correlation or causation? You want to talk about that, TK? Which one is it?
Not a
Yields
big fan
lower,
of the discussion.
Nasdaq doing nicely.
You know, you bring a seminar on a Thursday afternoon to a complete stop talking about correlation.
Well, should we do that seminar this Tuesday morning?
Absolutely, let's do it. Let's bring everyone to absolute snooze. No?
I think
you want to move on?
It's
All right.
often too simplistic within market study.
Okay.
It's great for theory. It's great for if you have a piece of chalk in your hand, correlation and causation.
Well, I'm teeing you up, Tom, just to say that
causation.
Maybe this is correlation and not causation. For Lisa to say it, I would say causation, and for me to kind of moderate the thing to make it less boring, but carry on.
Okay, well, on Wall Street, there's a lot to carry on. It is active, to say the least. You had the Mike Mayo splash a few days ago, about 200,000 American banking jobs exiting. How about on a global basis? Our team in Frankfurt, led by Steve Ahrens, has a definitive summation of the saving era at Deutsche Bank. John, Mr. Saving, to me, has been there like a cup of coffee, but yet we're talking about the saving era.
Well, the good news, Tom, is that every time there's been a crisis over in Europe, we haven't talked about Deutsche Bank as much, and that is true of Archegos as well. And I think that's got to have been the big shift, that we talk more about the likes of Credit Suisse than we do the likes of Deutsche Bank. So clearly, has something changed, Tom, or did they just get lucky? Which one is it?
Well, that's a really important comment. We're going to discuss that now. The luck of all this with Sri Natarajan, our Bloomberg Wall Street reporter. Sri, your focus is on Goldman Sachs, and they're really not a compare and contrast with Deutsche Bank. But nevertheless, luck is so much a part of this, as John Farrow mentions. Has Mr. Saving just been lucky to get into Deutsche Bank, managing it at the bottom?
Look, luck is certainly a part of it, but it tells you a lot that when we are talking about the Archegos situation, the shock here isn't that Deutsche Bank lost money, but they managed to dodge the bullet. There's a great line in the story that Deutsche Bank for long has been the perennial sick child of European finance. It has lost money in 5 of the last 6 years. Its shares are 87% below their peak. So the bar for success isn't all that high. It is pretty low, in fact. But even then, it is a sight of great relief for those senior managers in Frankfurt that everyone's talking about troubles at Credit Suisse, at HSBC, and elsewhere, whereas the Deutsche Bank stock in the last couple of years has jumped by nearly 70-80%.
Sri, can you talk about the distinction between a Deutsche Bank that a lot of people thought was just reducing risk dramatically and managed to avoid some of the pitfalls as a result, versus a Deutsche Bank that was using risk more intelligently, more deliberately, more targeted ways that they were actually going after big deals?
Well, you have to remember that under the new CEO who took over in 2018, and as Tom pointed out, very much at the bottom, the shares have nearly doubled since then, that there has been a massive overhaul. He's in the middle of this 4-year restructuring. The initial idea was to lean a little less on investment banking, to lean more into commercial banking. And the big worry when we think about the pandemic and the year of the coronavirus that has ravaged the global economy, everyone worried that a bank like DB would fall under the weight of bad loans. But instead, it is the investment bank and the outstanding success on that front, both on deal making and trading, that has helped it hold its footing, avoid the pitfalls like Archegos, and come out looking stronger than before.
You know, Sri, I want to get to the book value and then to the state of New York City right now. To me, the book value, and folks, this is all off the acclaimed Bloomberg Terminal BQ screen, which is really easy to use and is sort of apples to apples or more to it. Deutsche Bank cratering here, even with a comeback 0.46. Book, the giant commercial bank of Paris, BNP Paribas, 0.67. And then leading the way, 2 times book, rounded up, JP Morgan in New York. Sri, we forget how flat on its back European banking is. With that, what is the state of play for Deutsche Bank in New York?
I really don't think we at this point of time can be thinking about New York dominance, about U.S. dominance. In fact, the real contrast that you point out, Tom, is the difference between European banks and the American banks. Since the great global financial crisis in the last decade, U.S. banks have really pulled ahead. They have become the real major global force. In John Pruzan, like we discussed earlier, mentioned recently that some of the top 3 banks have created such a major competitive moat that you're no longer talking about the bulge bracket banks. You're talking about the super bulge bracket banks, names like Goldman Sachs, JP Morgan, Morgan Stanley. And when you have that discussion, the main European banks don't feature in the same league, which is why I say Deutsche Bank is not competing against the likes of JPM and Goldman Sachs. It is competing against itself. It is trying to make sure A, stays afloat, improves from a very low base, and then when people are talking about troubled spots in European finance, they want to make sure Deutsche Bank is no longer in that conversation.
Sri, just real quick here, another aspect here is the likelihood that Deutsche Bank will try to consolidate with another European bank as it shores up its balance sheet. Who is the likely contender?
Look, we've talked various scenarios over the last few years. We've talked about the need for creating a European champion. So whether it's one of the other major European banks you're talking about where they could combine with, or even possible combination with other German banks, it isn't clear how quickly they could move on something like that. At this point, I think it is really about shoring up their basic financial, making sure that they're in a strong footing, and any deal that they look to strike, they're doing it from a position of strength rather than desperation.
Sri, good to hear from you, sir. Sri Natarajan there, the Bloomberg Wall Street reporter. I didn't realise that the Time Warner Centre, Tom, becomes the Deutsche Bank Centre at 1 Columbus Circle. I didn't realise they get the naming rights too.
I didn't know that.
They do.
I'm learning.
Lisa, I imagine, knew that.
That's right at the Mendoza line there. It's 59th Street, and I don't go below 59th Street as a rule, John, but to be at 59th Street is even more challenging.
For a man that used to live on Central Park South, you never went south of 59. No. He just kind of walked parallel to the bottom end of the park. Is that
it's like magnetic force
he's lost
keeping him. Yeah, he's just getting
words on this. Did you ever make it over to the old Time Warner Centre?
John, after we paid the whole rent, we went over to Time Warner and paid the whole paycheck.
Coming up, David Costin at Goldman Sachs, the chief U.S. equity strategist from New York City. Equity futures up about 1/3 alongside Tom Keene, Lisa Abramowicz, Jonathan Ferro. Your equity market's doing a little bit better the last couple of days. A bounce for the Nasdaq on radio, on TV. This is Bloomberg Surveillance.
The risk is that not only the data comes in hotter, remains hotter, I think is kind of the important part of it. And the Fed is so far behind the curve that it's hard for them to catch up.
We've already had a bit of a melt up in the first half of the year, so we don't necessarily see another melt up happening.
Inflation could keep rising. It's already rising, but stay higher for longer.
Even if we get some decent CPI prints for the next several months, I don't think that's going to be enough to force the Fed's hand into tightening any time before 2025.
before.
You cannot really push the story of average inflation targeting and then have a rate hike as soon as 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thrilled you're with us on radio and television this morning. Coming up, our equity discussion of the day. David Kostin will join us from Goldman Sachs. And part of that is the good news. The Kostin bull market call, John, is about the end of this pandemic. And Moderna steps in where Pfizer has been.
Here come the headlines, Tom. The COVID vaccine highly effective for adolescents in the Moderna study. 93% to 100% effective in a study of 12 to 17-year-olds. Tom, that's not going to surprise many people. From here, the process continues. The company will submit for regulatory authorization in early June. And then from there, Tom, you imagine this one gets rolled out.
It gets rolled out. And to me, Lisa Abramowicz, it's about the quiver of solutions. It's not anymore one target, one silver bullet. It's a quiver of solutions for nations that are ahead, like the United States and the United Kingdom, and too many nations behind.
Yeah, and also here, basically, Moderna would then follow Pfizer in terms of vaccinating those age 12 to 15. The question now is below that, what about younger adolescents? And are we almost out of the pandemic, Tom?
Stock moving 2.2%. John, just because of the importance of the moment, we need to really frame the equity markets. Futures up 15, Dow futures up 92, not on the cusp of 35,000, but John Ferro notes 18.36 on the VIX. That's a David Kostin number, isn't it, John?
Nasdaq 100 futures breaking out too, Tom. Up 75 on the Nasdaq 100 this morning, up 0.5% after a really tidy rally in yesterday's session. Growth has made a bit of a comeback. Now, is that just a little bit of a bounce that fades, Tom? What are the signposts that you look for to try and understand whether that move's a little bit more durable?
I'm going to go to sector rotation here with David in a moment. Lisa, I do want you to step in here now. With every Friday, the anti-Kostin comes up, and it is the pendulum of gloom. There's no other way to put it. There's a whole cast of characters saying Kostin is wrong.
That's called bond investors. No, I mean, in all honesty, there is a question, and to John's point, about the growth names. It's big tech, some of the names that did the best during the pandemic, having a resurgence. It's coming in tandem with a flight to quality, even within credit. You've seen this sort of rotation into higher grade bonds from the lower grade bonds recently, and you've seen those extra yields fall to post-crisis lows. And again, this comes at a time when people are concerned about inflation, which raises a question of why they are expressing that concern in a flight to safety, Tom.
One question on the other news stories. There's a million news stories this morning, folks. It's actually quite a busy morning. John Ferro, when I look at Belarus and the flight, you're our expert on Ryanair and on British aviation. Have you been surprised at the response from UK?
Are you calling me the expert because I'm the only one of the three of us that's been on a Ryanair flight?
No, it's because Guy's on at 10 o'clock and you're the only one that has a clue.
EU's on the same page when it comes to dealing with this, and I imagine the UK will be as well. Where there is some difference around travel right now, Tom, is how to reopen things for the summer and who is going to curtail access of UK tourists into Europe, because Germany and Austria have made that move in the last couple of days, and Spain's saying the door is open. France is considering closing the door. That's where there's some confusion right now, Tom.
Okay, what we're going to do right now is bring in David Kostin. He is Chief U.S. Equity Strategist for Goldman Sachs. We've got a whole bunch of questions as he resets for S&P 5,000. But David Kostin, we must celebrate, as you do at Goldman Sachs, with a fully staffed Team Kostin today in the office. I want you to explain the path to get your team ensconced at Goldman Sachs again.
Well, I want to definitely congratulate all of our whole team. The entire team is here for the first time in 15 months. So we're pretty happy about that. And the process has been halting. We had some density restrictions in terms of the seating arrangements, but given the way we've been able to use some extra offices, we're all here today. So I'm happy about that.
What changes, David, for you as the team gets back around the table together again? What's the big difference?
Well, the difference is just the interaction and being able to have small conversations about different issues that come up on a computer screen, call someone over to point it out. Some people wear masks still, but generally speaking, everyone absolutely has been vaccinated, twice vaccinated, things like that. It's just a much more efficient way to communicate. Of course, we were doing that before with people remotely, but just an incremental amount of communication. So I think that's really helpful on our team. So we're really happy about that. And I think in my conversations with clients, more and more of them seem to be coming back to working from their offices. And there's different portfolio managers have different time frames to kind of re-engage. But right here today, my team, U.S. Portfolio Strategy, we're all here.
Well, let's shine a light on one of the debates at the moment that I imagine you and the team are having right now. The Nasdaq's made a bit of a bounce, David, and earlier in the conversation on this program, we were talking about whether there is a correlation or a causation between what happens with rates and what happens with growth, big tech. What are you and the team saying about that?
So the interplay between growth and rates and inflation obviously has a lot of different dynamics, and I would unpack that in sort of two ways. How does inflation affect the equity market, broadly speaking, and then which sectors in particular? And so we think about it, the transmission mechanism on the one hand is on valuation, because the impact of higher inflation leads to generally higher rates, and that has an impact particularly on some of the longer duration, longer expected growth stocks. But there's also a transmission mechanism through margins. And so I think we need to bring both of those together and think about it. What is one of the attributes of the technology sector is they have extraordinarily high margins, and they've been relatively immune, pun intended there, relatively immune from the higher inflation curtailing their margins. So on the one hand, you have a suppressing or a depressing effect on valuation for inflation and what that means for rates and the valuation of that long-term expected growth. And on the other hand, you have the durability of their margins as compared with some other more cyclical sectors where their margins may not be so robust in terms of ability to pass through those higher input costs. So I think those are the two things that we are trading off one against the other. And I think my view is that the margins are going to become the more dominant topic of conversation. The idea of transitory is a debate we will be having consistently until October, right? We'll put a stake in the ground and say that's for 6 months. And so the Fed has indicated its view. My colleagues at Goldman Sachs economics team also have a view that the inflationary impulses are relatively transitory, and then we'll recede back towards the sort of 2% core PCE next year. So that's sort of the issue. We're going to have that repeatedly. I think the more interesting analytical debate with portfolio managers is around the durability of margins. And margins, Jonathan and Tom and Lisa, have recovered now to their pre-pandemic levels. So they're already back to where they were February of 2020. And so the question is, from here, where are we going? And my view is margins are going to be relatively flat. And a big variable there is the tax rate, the corporate taxes. If you told me for a moment we will not have corporate tax reform, then we'd have earnings growth of around 10% from this year into 2022. Now, that's not our view. We expect there's going to be an increase in corporate taxes, and that is going to mean that growth in earnings is going to be around 5%. And so you pay a different multiple for a 5% growth as opposed to 10% growth.
David, this has been the story that big tech can pass on pricing increases. Big tech reigns supreme again and again and again, and that is why it is the top holding for so many companies, for so many investors. At what point do you start to worry about concentration risk yet again as hedge funds double down on, say, Facebook positions after already having large positions outstanding?
Well, it is interesting you mentioned Facebook, as it is the largest stock in our hedge fund. Very important position. It's a basket we have on Bloomberg. Been tracking this now for 20 years. Every 90 days, we're looking at around $2.8 trillion of long and short exposure, and that's the most most important position. It supplanted Amazon that previously had that position. We just published that last week. And so, yes, it's a big topic of conversation, just how sort of dominant these can be. Now, right now, Lisa, these 5 stocks, the big 5 companies that we all know, are comprising around 21% or so of the S&P 500 equity cap. But last September, that was 25%. So the actual concentration has diminished slightly. And perhaps more importantly is in the growth index. If you look at, say, the Russell 1000 growth index, this was a big issue for diversified growth mutual funds, where the passive index weight in the Russell 1000 of the 5 largest companies put a number of funds in excess or tripping, if you will, the diversification requirements of the SEC. That has come down a little bit as these companies, as big and dominant as they are, relative to the rest of the market, they've receded a little bit in terms of their concentration. So the question we think about and the discussions with fund managers, Lisa, is, well, just how further can they run? If you think about what happened year over year in revenue growth in the first quarter, they were up 41%. Up 41% compared to the rest of the market where they were up modestly in terms of sales growth. And so the idea and even think of the worst part of the pandemic in the second quarter last year, the worst part of the pandemic, year over year, these companies had 18% revenue growth. Rest of the market was down around 7%. And so we're looking forward and ask ourselves, well, these companies are pretty durable in terms of their growth. They're expected in terms of revenue growth 3 times faster than the rest of the market in terms of top line sales. They trade at basically about 5 multiple points higher multiple than the market. Market's like 20, 21 times right now. These are sort of 25, 26 times. So they're trading at a premium valuation, no question about that. But they're also offering better growth.
David, in the time we've got left, I've got 8 ways to go here, and I do want to congratulate your team on their Amazon research of a couple weeks ago. I thought it was great how you went to cash flow. There's a lot of people out there cautious short-term or a cost and long-term view, and one of them is Douglas Cass. Doug Cass is cautious right now, and Doug Cass is saying, I don't care what Costin thinks about the bull market, there's no volume out there. How does volume play into your view of the equity markets?
Well, when I think about it in terms of liquidity, in terms of low versus high liquidity stocks and groups of companies that have more or less liquidity from a trading perspective. And the market's actually rewarded companies that have relatively lower liquidity. And that's just a factual statement in terms of the performance. Doug, I haven't talked to him in a while, but he's generally more on the bear side than the short side. So wouldn't be surprised he'd have a more cautious take on the world. To be fair, the market right now in S&P is 4,200. Our target for the end of the year is around 4,300. So pretty modest upside, to be very clear. And that is likely to be shifting from more cyclicals, which has done really, really well so far, towards more of the growth. And the idea behind this intuition, Tom, is the economy is peaking this quarter in terms of growth rate, like 10%. And that's going to decelerate, still grow, but at a slowing pace. And that's where the transition and handoff to some of the companies that are positioned to grow at a more extended level. And the intuition behind that is the companies that are investing in their business. And that is what makes some companies differentiated from others. The typical company invests 11% of its cash flow from operations to grow its business. And there's a portfolio of companies where there's 75%. And so it's big companies that we talked about earlier, around 65%. So it's an enormous amount of investment to grow into 2022. And make no mistake about it, all of the conversations with fund managers are about the growth prospects in 2022.
Hey, David, love catching up with you. Fired up because the team is back in the building. And David, we're excited to have you in the building with us soon around this table at one point in the future, maybe in the next 12 months or so.
I can lean over. Oh, Lisa, could you pass me the Tang, please?
Lisa can't wait.
Please, could
From
you
New York City.
Throw it at the glass
This
wall.
is Bloomberg Surveillance.
If we saw some development pushing inflation up, I wouldn't expect that to get embedded in the ongoing inflation rate. Of course, if we did see inflation that moves persistently and materially above our goals in a manner that also threatened to have some impact on those long-term inflation expectations, we have the tools and the experience to gently guide inflation back down to target, and I think no one should doubt our commitment to do so.
You're going to hear that conversation on repeat through the year. As David Costin of Goldman Sachs pointed out, you'll hear it all the way through October. That was Lael Brainerd there, the Federal Reserve Governor from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. About an hour and 12 minutes away from the opening bell, your price action looks like this. Advancing on the S&P by 13 points higher by about 1/3 of 1%. On the Nasdaq 100, 500 up 71. We advance 0.5% there. In the bond market, yields are lower by about a basis point to 158.93. Euro dollar 122.65. Stronger euro here now. Another lift in the last 10 minutes or so. Euro dollar up by a couple of tenths of 1%. If we can get to Moderna just quickly, I'll bring you where Moderna stock price is right now. Up a couple of percentage points in the pre-market off the back of the following headlines. The Moderna COVID vaccine is highly effective for adolescents in a study conducted recently. 93 to 100% effective in a study of 12 to 17-year-olds. That stock, Tom, is up by about 2.75%.
Those are big effective numbers versus some of the other more suspect vaccines. One question out there is this quiver of vaccines that we have that seem to grow every day. John, along the euro, we've been euro this morning. Where's that quote? 122.65. That's up 10 pips. P-I-P-I-S. Gladys Knight in the pips. I'd also note renminbi out to new strength. Yeah. This snuck up on me. I really sort of missed this morning, but the Chinese yuan strengthens out near a 6.40, 6.41 level. That's a really telling statistic.
Did you read about how the central bank over in China was actually hoping for a little more strength to offset the commodity inflation, that they thought that actually could help the economy? So perhaps this is part of the response there.
Easiest way to weaken the commodity complex overnight is to let this weaken.
Yeah.
Not strengthen. Straightforward. If the Chinese start to say, we want a weaker Chinese currency, you watch what happens to the commodity market overnight. Well, that's going to have to correct quickly.
The dynamics here, and to me, it's the dynamics David Kostin was talking about, is the complexity here, as Anna Hahn was talking about earlier, is really tangible as well. And that goes back to foreign exchange, yes, the litmus paper of the market. We all know the cliches. John knows they all drive Ferraris in the city. But the reality is Ira Jersey's boring bond market tells us and sends signals. Ira Jersey joining us now, our U.S. interest rate strategist. Ira, what is your key signal right now from one-day paper out to 30-year bond?
Yeah, that the market is still thinking that we are going to get more inflation, and I think that commodity story is certainly part of it. When we're talking about 2.5% inflation, it's almost the Goldilocks scenario for the Fed if the market's expectation is realized, because it ends up being a little bit higher than we've had the last decade in terms of inflation, but it's still not runaway, right? And that I think would be the situation that the Fed really wants to be in. And will it be realized, or will we get runaway inflation? I think that's what people are worried about at the moment with a lot of these trades.
Ira, based on the idea that the Fed has to start talking about tapering, then start tapering before they even begin the conversation about raising rates, do you think that James Corman could be actually right when he says that the Fed could start lifting rates as soon as early next year?
I think next year would still be a little bit early. Obviously the market is pricing some chance of a late 2022 interest rate hike. I think the question is, what type of inflation do we get? Do we get the inflation that's in goods and that's driven by commodities and by potentially higher energy prices, or is it being driven by wages and things that the Federal Reserve really wants it to be driven by? And I think the Fed is going to be concerned about things like income inequality. And the fact is that the pandemic, if nothing else, has actually made a wider disparity between the haves and the have-nots in many situations. So I think the Fed will wait to raise rates a little bit longer than the market is thinking, and I think a lot of people are thinking. Now, that doesn't mean it won't taper. I do think that they'll start to reduce their asset purchases at very early in 2022, and like you mentioned, Lisa, they have to start talking about that relatively soon, probably in 3Q, at least lay out what they see as the plan for that, and then say the timing will be based on incoming data, things like that. So they won't give a timing, I think, in August, but as soon as they start to say we have a plan, the market is going to act maybe not like the 2013 taper tantrum, but it's going to rhyme, I think, a little bit.
Okay, so let's talk a little bit about what that looks like. So I'm looking at a 10-year yield of 1.59% and wondering, is this pricing in a taper or even a discussion of a taper in the next couple of months?
Well, a little bit, but not a lot. I think earlier this year in January and February, when we had that pretty dramatic sell-off, there was the idea that we were getting away from needing another round of QE and needing and pricing in some chance of a taper at some point. I think the big thing to look at, Lisa, is going to be TIPS yields. So yields on the TIPS on 10-year tips right now is negative 88 basis points. I think when you see taper, that's really where you're going to see the pain, and those yields are going to rise pretty significantly, 50, 100 basis points perhaps, and that's where you're going to start to see 10-year yields rise above 2%. We have 2.3% for the end of this year, so you're still talking about a nice, 70 basis point sell-off from these levels. I think once we start thinking for real about taper.
Ira, did we get a taste of that last Wednesday when we got the Fed minutes?
Yeah, very little bit. Yeah, you had that nice 9-10 basis point sell-off in the 10-year. We've now reversed a little bit of that. But I think the market is still a little bit skeptical as to, the resolve of the Fed and will they be willing to actually taper given some of the data and how volatile it is. And they keep talking about looking past this bout of volatility because of base effects and the like. But nonetheless, I think that the recovery is still well underway. It's just a matter of what the pace of that recovery is going to be in the second half of this year that will ultimately drive exactly when they start to taper and how loud the chorus is about needing to taper.
Question of the morning, Ira. Did you see the Cristiano Ronaldo Instagram post? Isn't that the most
I have not. I hate to say that. Now you
come on.
me
He talked about
achieving
achieving his goals. Went on to say thanks to everyone who took part in this journey. We stand together. Is he done?
Oh my God!
Oh, that sounds like it, doesn't it? I wonder where he'll go. Go somewhere else.
Maybe go to the
I can't imagine he's done playing yet.
I don't think so. Ira Jersey there.
They're saying PSG. They're the only ones who have the money.
Very true. TK, I love when you come out with real knowledge about football. I can tell you've read. They are saying PSG maybe. Maybe that's who's got the money, and maybe Mbappe goes over to Real Madrid. Although I heard some rumours over the last couple of weeks that maybe he goes home, Tom, back to Portugal.
Maybe the Padres will pick him up. What do I know?
Maybe he'll sell some jerseys.
Can I mention, John, very quickly here? David Rosenberg out moments ago up in Toronto, and he says the real inflation, well, you know what? It's not that real. Rosenberg and others are really pushing against the gloom of higher inflation.
He's pushing back hard, that's for sure. Julia Coronado joining us next, Macro Policy Perspectives President and founder. Looking forward to that with yields lower by about a basis point at 159.27. Your equity market higher, advancing a third of 1% on the S&P 500. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance. One hour away from the opening bell from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your price action is Tuesday through 4,200 on the S&P, advancing 13 points, up a third of 1%. Yields a break of 160 to the downside, unchanged almost now. We're down not even a basis point at 159.44. And euro dollar, a euro that is stronger, dollar weaker through most of G10. Tom, 122.62 on euro dollar. That currency pair moving by about 0.4% to the euro's favour.
Really interesting Tuesday here. We got a lot of housing data coming up. I believe you'll see that on the open with John Farrell. Look for that.
Thank you, Tom.
In the 9 o'clock hour. In a more interesting market today, certainly than what we saw yesterday. It's now time to frame the Fed. We can do that with Julia Coronado, Macro Policy Perspectives, her president and founder. Julia, the equity market is voting. It has been up. Maybe it's a raging rally, as Doug Cass calls it. How do you use the stock market within your Fed economics? The stock market, rather, is voting optimism.
Right. And Chair Powell is a financial conditions guy, so he does use financial conditions broadly to calibrate how easy or how supportive policy is. And right now the markets are saying yes. Policy is supportive and it's going to work and it's going to create a strong recovery, and I think that's exactly where they want it to be.
Within the equation, where do you see that within investment? We don't talk enough about it. It's a smaller number than consumption, but investment, well, it's got a volatility. What is that volatility right now into the end of the year?
Well, we saw a very strong investment recovery last year. In fact, investment ended up stronger at a higher level than pre-pandemic by the end of the year. So I think that bodes well for gains in productivity this cycle, and also for that optimism you talked about earlier. Companies are putting capital to work. They obviously see prospects for making money by doing so. So I think that that's a very good signal. As you say, there is some volatility, and it probably won't keep rising at the pace we saw in the second half of last year. But it does seem to be on a positive track.
Julia, how do you gauge productivity, and how easy is it to get a clean read on what is happening in this economy?
Oh, it's really hard right now. I mean, it's going to be hard for a while. Everything is going to be extremely noisy this year with the reemployment of a lot of people, with the shifting in the mix of workers. We've seen, as we usually see, a strong productivity performance during a recession as companies struggle to survive by squeezing every bit of efficiency out of their operations that they can. But I think, so it's going to take a little bit of time to see whether we settle at a higher trend in productivity than we did last cycle. Last cycle, we saw pretty disappointing performance throughout the recovery and expansion. And I think that there is some thought that, the pandemic accelerated business transformation. It brought forward a lot of plans, and that could result in higher productivity. And then the question is, how do we balance that against the frictions associated with dealing from where does work from home go from here? How do companies navigate and manage their workforce with some employees wanting to stay remote and others wanting to come back to the office? That's going to be a management challenge.
Julia, give me a second just to bring our audience some news. It comes from CNN. The president, Joe Biden, set to have a summit with the Russian leader, Vladimir Putin, and expected to take place June 15th, 16th, Tom. That just coming from CNN. That Biden-Putin summit expected to take place June 15th, 16th. The president in his first overseas trip to Europe next month. That trip gets a little busier.
In NBC talking about yesterday, I believe, that it would be in Geneva, Switzerland, which has a whole symbolism to itself when you look at the tensions across continental Europe right now.
A lot to achieve, Lisa, in a small amount of time next month through Europe.
Yeah, and it raises a question how much of this could potentially factor into the economy. And I think about that when it comes both internationally as well as domestically. I mean, John, we keep talking about this infrastructure bill that seems to get being pushed back further and further. And now there's a question of whether it will get passed at all. And yet there are no adjustments being made to economic forecasts based on that.
Well, how do you make that adjustment, Julia? How do you think about what's happening in D.C. and how you plug that into your forecast, your outlook for this economy?
I think a lot of what we're seeing right now is sort of the political theater around the infrastructure bill. We're not adjusting our forecast because we do think it's going to get passed. And the question really for us is, how big is it and how much of it is paid for through higher taxes? And that still seems to be in a state of flux. But overall, we do think that the bulk of the infrastructure proposals goes through. The question is just, is it bipartisan or a party line vote?
Well, but Julia, there's a question of how much this higher inflationary regime that people talk about hinges on this presumption that you talk about, that infrastructure will get passed something resembling where it is right now in the proposals.
Yeah, no, I think it is an important contributor to the outlook, although, I think remember that infrastructure is something that gets spread over 10 years, so it's not a replacement for a fading fiscal impulse. We are going to see a fading fiscal impulse. We've had a tremendous recovery push that has been stoking a lot of the supply chain pressures. That's going to ease back as we move through the year and into next year. But underlying that is a pretty decent recovery so far. So we expect, given the GDP tracking, we're going to see a nice bounce back in May hiring. I think April was the outlier. Maybe we do have some frictions reconnecting people to employers and some sectoral reallocation, but there's a lot of demand out there, and I think ultimately that's going to lead a strong labor market recovery, and we won't be as reliant on the fiscal impulse to get a decent economic performance next year. So I don't think it's the be-all and end-all. I do think it will cause sectoral reallocation. You're pulling in resources for this infrastructure agenda, and that will move resources towards that from other sectors so that might be different otherwise. But I think we are going to hand the baton back to the natural expansionary dynamic towards the end of this year and into next.
Julia, can you elaborate a little bit about April being the outlier and expecting hiring to really pick up? What has been responsible for this labor market shortage at a time when there are still so many people out of work?
Yeah, I think there's a lot of frictions. There was actually a really nice article on restaurant workers in the Washington Post this morning that was talking to the workers themselves. We're coming out of a pandemic, and we shouldn't forget that. A lot of people have made changes in their lives. They think about their work differently now. It is forever changed. If you are on the front lines, you don't look at your sector the same. And so you're making decisions about where do I want to be, what do I want to be doing, and what am I willing to work for? And so we're seeing that negotiation happening right now. It's not a question of whether people will return to work. It's where they'll return to work, at what wage, and then how that all sort of settles out in coming months. But we've got millions of people who are actively looking for work.
Julia, very quickly here, one final question to your point on wages. Are they transitory?
Yeah, I think what we're seeing, Tom, is something similar to what we're seeing on the price side. So you've got a excess demand for workers in certain sectors. That's going to lead to a level shift up in their wage rates. We're seeing that very clearly in the leisure and hospitality sector. So, and I think that's long overdue. So that's great news for those workers. That could be a relative price shift, right? We could see less buoyant wage gains if that's compressing profits in other at the top end of the wage spectrum. And that's something we saw at the end of the last cycle pre-COVID when we were in a very strong labor market. We saw the lower wage workers getting the strongest gains, the biggest raises, and the top end workers seeing their wage gains slow a bit. And that kept the overall wage bill sort of moderate, the growth in wages moderate. And I don't see any reason why we shouldn't see that same kind of dynamic with a relative shift with lower wage workers, especially frontline workers, getting the biggest raises as we reopen the economy.
Julia, always enjoy catching up with you, particularly this morning. Julia Coronado there of Macro Policy Perspective. Just to recap that news from about 5 minutes ago from CNN. The first face-to-face meeting between President Joe Biden and Russian President Vladimir Putin expected to take place next month in Switzerland. This according to two U.S. officials speaking to CNN as the White House and the Kremlin move closer this week to finalizing arrangements for the summit, which will take place, Tom, next month.
Well, it'll be next month, and there's a lot of news flow before that, obviously with the Belarus overlay that we've seen in the last few days. But you wonder how their agenda can be organized. There are so many things to talk about.
Brussels, London, now Belarus. A lot of stuff to work out, Lisa, in a small amount of time. That is quite a first overseas trip for this president.
Yeah, fraught is a word that I would use, and I wonder how much domestic politics are going to weigh in on this, how he can sort of toggle between the sides of the Democratic Party, let alone the Republicans, and present a front, a new front for the United States that will be palatable to all.
The market right now up about 80 on the Nasdaq 100, advancing 0.6%. You called Monday a snooze, Tom. You calling Tuesday a snooze?
No, it's not a snooze. And what's interesting is in foreign exchange, it's really nuanced. You look away from the dollar, John, at Euro Swissy really not showing much this morning. But Euro Yen speaks volumes about stronger Euro. And there's a real Pacific Rim dialectic now, excuse me, between Euro and Yen, and yet at the same time, dollar renminbi shows stronger yuan. It's a really interesting mix. I looked at Singapore dollar to confirm that. I don't have new recent strength in Sing dollar, but it's getting there quickly.
Euro dollar 122.58. Also looking out for that deal to cross at some point, maybe later today, Lisa, between MGM Holdings and Amazon, that $9 billion deal that I believe the Journal was the first to report in the past week.
Yeah, we're looking for that. I just want to follow on because you were talking about the Chinese yuan and how it's reached the strongest versus the dollar since 2018, Tom. And I went back and I looked, and over the weekend, do you remember this? The central bank came out and they were talking about higher commodity prices. And one central bank official in China wrote an essay saying that perhaps the yuan should appreciate to offset the higher cost of commodity imports. That blog post, John, has since been deleted, and people have come out to try to fight back on this, but it highlights some of the dissent within the Chinese central bank as to how to handle this appreciation in the currency.
Yeah, that can move against them pretty quickly, pretty fast. The Cisco CEO, Chuck Robbins, will be joining us in studio in about 20 minutes.
Nice.
That'll be a good sit-down.
TV. I'm looking forward to that sit-down a little bit later in the next hour.
You're putting him behind glass?
Lisa Abramowicz, Jonathan Ferro. The glass thing is just for me and Tom, Lisa. I'm sorry you've got caught up in this. I really am. Sorry you've got caught up in this. Hi, TK.
How's it
How you
going?
doing? We're both vaccinated.
You're
Just
waving?
maintain that 30 feet distance from me, won't you?
My back hurts now so bad.
I'd love to
Zoom
say that. I'd love to
Bloomberg.
say this is the president vice president setup where we can't be in the same room. Who's the president, Tom? We'll leave that there.
Dr. Phil.
This is Bloomberg.
They're capturing it so well.
With the First Word News, I'm Rishka Gupta. Moderna's COVID-19 vaccine was highly effective in 12 to 17-year-old adolescents in a large study, paving the way for regulatory submissions around the world by early June. The drug maker said today its vaccine was between 93 and 100% effective in preventing COVID in a recent study of teens. That puts Moderna's vaccine on track to soon become the second shot authorized in the U.S. for that age group. Secretary of State Antony Blinken kicked off a Middle East diplomatic mission today with a pledge to help reconstruction efforts in Gaza. Speaking in Jerusalem alongside Israeli Prime Minister Benjamin Netanyahu, Blinken said he will specify an aid package to the Palestinians. He vowed the U.S. will ensure the militant Islamic terror group Hamas won't benefit from the rebuilding efforts. Backed by the U.S., European Union leaders are moving to impose new sanctions on Belarus over the forced landing of a Ryanair Holdings jet and the arrest of a dissident journalist. The EU called on Belarus President Alexander Lukashenko to release the journalist and for aviation officials to investigate the incident. President Biden called the incident, quote, a direct affront to international norms. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
What we saw earlier this year in terms of yields, in terms of real yields, kind of coming off the bottom, if you will, being less negative, if you will, is an example that the market is not necessarily 100% comfortable with the Fed's ability to do everything that it says.
Marvin Lowe, State Street Senior Global Strategist there. Good to have him on earlier this morning. We celebrate futures up 14, Dow futures up 80. The VIX is a huge deal from that 2021 level off of 27 gloom into 18.32, showing the better tape. Lisa Abramowicz and Tom Keene, John Farrow preparing for a magnum opus here that we'll see at 9 o'clock. And right now, Barry Ritholtz joins us, our Bloomberg opinion columnist. Barry, Doug Cass was talking up volume today as being low. You have written on this, including in 2007, where price and volume tell all. To be fully clear, folks, I don't believe in volume study. Barry, do you?
Well, it is a truism that volume often precedes price in a specific stock, but, you know, you have to look at the context, and the context is after a hellish year of lockdown, heading into a long weekend, the economy is reopening. I think anybody who could get away from their terminals, get away from their trading desk, has done so. If you're surprised that volume is light this week, well, then you're very easily surprised.
Barry, you know, if we go back to think Mike Santoli writing for Barron's and the world stopped Saturday morning because you had to read Mike Santoli.
Right.
Now he's over at the Death Star. Fine. The volume today isn't the same as when Santoli was writing for Barron's.
That's right. You have a giant rise of passive indexing, which just is a slow, steady, relentless bid. What is it? 11% of all U.S. public companies are held by either BlackRock or Vanguard. So there's that element. And then on top of that, you have the algorithmic trading and the high frequency trading. It's not the same sort of volume flows that it was 20, 30 years ago. In fact, if you look at flows, some people love to look at inflows and outflows. Outflows have dominated for most of the 2010s in a period where equity prices just went up and up. So I don't think you could read a whole lot broadly into volume, but I do still cling to the concept that volume can confirm price action in a specific stock or a specific sector.
In other words, conviction, right? I mean, if there's a lot of volume and there's price action, then that can indicate perhaps greater conviction about the direction of a specific stock or, frankly, an entire market. What is the conviction like right now at a time when people have seen froth? Perhaps it's come off a bit with respect to SPACs and some of the high flyers. And when people are looking to a potential deceleration of growth expectations already priced in.
So keep in mind, again, I hate to keep going back to the lockdown pandemic. We saw the rise of stocks as entertainment, or maybe I should call that, the resurrection of that sort of 90s era. Hey, everybody is now a stock expert. And so between Robinhood and meme stocks and Reddit, lots and lots of people were participating. And wait, I could go sit on a beach without a mask, and I could go to a restaurant, and my next door neighbor went to the Mets game last night and sat in the vaccinated sector. Hey, when all these people, section, not sector, when all these people are no longer stuck in a spare bedroom staring at a computer, I can't be very surprised that volume is tapering off. And I don't want to read too much into that as, oh, this shows you a loss of conviction and speculation and froth has run amok. There's froth and speculation. There can be no doubt. I'm surprised none of us really anticipated the rollover of the crypto coins as the market reopened. People found other stuff to do.
Well, but hold on a second. This is actually really important. And putting crypto aside, if people are finding other things to do, will some of the money that's funneled into markets because it had nowhere else to go start funneling into the real economy in a more significant way?
Yeah, that would be horrible if companies saw more revenue and profits. I mean, that would be terrible for equity markets, don't you think?
Horrible.
Oh, wait, rising revenue and profits are good for stocks. So rather than have people day trade, they go out and buy stuff. I'll take that over meme stocks and Reddit.
Barry, I look at where we are, and we're just staggering through to another bull market. I mean, we're right up, buttressed up against record highs here, there, and others. What will push us to record highs? What is the fundamental catalyst where people rationalize comfortably being at a new price level?
So a couple of things, and let's start with earnings.
Or cash flow.
Right? We're working our way through earnings seasons, and you have to recognize it's been pretty spectacular. Already lofty expectations have been met. Now, how much of that is built into prices of equities, that's a different conversation. But I like the fact that we're seeing earnings come in very strong, that people are underestimating the strength of the economic recovery, and don't underestimate the fact that record highs and new all-time highs is a bullish sign. You don't end up with record highs in a bear market. You only get record highs in a bull market. And if you look at the history of past bull markets, record highs beget more record highs.
Barry Ritholtz, thank you so much. Greatly appreciate it. Bloomberg Opinion, particularly there on volume, the conundrum, should you follow volume? And I'd even fold the put-call ratio in there as well. Lisa, I hope that wasn't too nerdy. I mean, I just, after
You're
Anna
asking
Hahn,
me if something is too nerdy? Nerd it up. Go ahead.
We did Cartesian geometry with Anna Hahn and volume dynamics with Barry Ritholtz. Lisa, what do you see here?
Honestly, I'm looking at a 10-year yield that is 1.596%. I'm sort of surprised to see the idea that inflation expectations have actually started to come down, and that you're actually starting to see people hide out in securities that are thought of as safer. I find that compelling at a time when we're seeing really good economic data and trying to understand what this means going forward and whether this could be something that could become a problem at a certain point. Slow growth is not what the Fed wants to see.
Another story percolating here. We really didn't cover it. And granted, we got Amazon MGM supposed to be racing out here at some point. But at least I'd really point out David Kostin's comments on the FANGs and how they've been unloved over the recent number of months.
Yeah, and basically how people are starting to like them again because they have pricing power. When you go to the Apple store, you are willing to shell out how much for the iPhone
Buds,
12?
forget the phone. It's the AirPod buds.
Yeah, you what, have a collection of them under your couch?
Yeah, well, we have a collection. Kennel Feed pulls them out, and, he looks, she's styling with her little buds there.
Well, you see, I actually thought that the other really important story of the morning was Moderna. And the idea that we're getting the vaccinations that are eligible for kids that are quicker and quicker. And I'm wondering, when are you going to get the ones under 12 years old? And what does this mean in terms of getting back to work?
Okay, we've got a double barrel for the morning on radio and television. The senator from Virginia, Mark Warner, on Balance of Power. Looking forward to that. But I really am interested in what Mary Callahan Erdo says of JP Morgan at a time of change at our largest bank. Stay with us on radio, on TV. This is Bloomberg.